Well, let's be on. All right. So let's get started here. It's August 3rd. It's 11:15 a.m. and we'll call the regular meeting of the Board of Investments to order. We are recording this. Be aware of that. And Lindsay, would you do a roll call, please?
Sure thing. Carl England,
Here.
Jack Prothro,
Here.
Terry Cohe,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Daniel Trost,
Here.
Jeff Meredith is absent. Representative Ken Walsh, I don't see him. And Senator Ryan Lynch is also absent. So we have 8 board members present. We have a quorum.
Thank you. Are there any public comments on issues within the board's jurisdiction? Any hands raised? Nope. All right. Before we get to the doing business and the approval of the minutes, et cetera, I think this is the first time that we've all been together with Dan, our new board member. Welcome. Thank you for doing this. We missed having someone from TRS here, so appreciate your willingness to do this. 2 boards.
No.
Get rich on this. And a busy home life. So thank you very much, and it's a pleasure to have you, and welcome.
Thank you. Happy to be here.
Thank you. Minutes of the May 25th through 26th board meeting. Everybody have a chance to look at them, and
I do. I have a question for you though.
for me,
Yeah.
okay,
So on the approval, you signed for the board, but you weren't there for the minutes. Does that matter?
well, once they're approved, then I'll sign.
Then you
Yeah,
sign. Okay.
I won't sign them before they're approved, though.
We wouldn't want that.
Okay. Do you want to make a motion to approve?
I would make a motion to approve the minutes.
Okay.
I would second that.
Okay. Any discussion? If not, all in favor, say aye. Aye. Any opposed? Motion passes unanimously. And now I can sign
Not that one.
it? No, right. Let's deal with some committee reports. Audit Committee, Maggie.
This will be the shortest report ever, probably, so enjoy it. Julie updated us on the audits, Julianne, Executive Director Villa. The LAD will be planning and doing their planning and field work starting in August. For the financial compliance work, this is later than usual, based on our conversation, but we'll still be able to accomplish it because we've become so efficient. Withley, the draft SOC audit will be presented at the October board meeting. They completed their walkthroughs in May. They're scheduled to complete their final testing during the week of August 8th. They're actually going to have half of their team on site and half doing it remotely. Julie noted that they submitted 1,300 documents as requested by Withley, so you know this is a thorough examination. We also talked about the fact that we met, they updated the checklist indicating that we met on July 20th to finish our working session and review of the governance policy sections that were remaining, but will not be approved until a later meeting. So that's my update.
Okay, any questions, comments? If not, Jack, Loan Committee report?
Okay, loan committee met today and we approved 2 loans. One to the West Yellowstone School District for $1,500,000 to have them work with their employee housing. It's a 10-year loan with their general promise to pay back. We also approved another intercap loan to Hinsdale Public Schools. That one was for $1,138,536 to help pay for some of their building updates for both the elementary and high school. Again, a 10-year loan with their general promise to pay back. Those were voted on and approved by loan committee, and they're under the limit, so it does not have to be voted by the full board. I'm open for any questions on any of the loans.
Anything from anybody? If not, HR committee report, Terry.
The executive director informed us that the director of private investment has left his position and outlined the procedure for advertising national need to replace that position. And hopefully we'll be making a recommendation to us in December on hiring of that position. The board then unanimously approved moving Thomas Winkler to investment officer of private investments. And then and Thomas is already exempt staff, so the board needed to make that decision. And then the board voted again unanimously to follow the current policy of providing exempt compensation adjustment to staff in temporary positions. Any questions?
We need motions for, I think, both of those.
So does anyone have a motion on the recommendation of to transfer it to the exempt staff?
I would make that motion.
Second. All those in favor?
Aye.
I'm supposed.
That's right. Full board.
Committees can make.
Oh, no.
Committees can make motions.
Another type Pepsi. We'll move the fridge. in
All
here.
right, so the recommendation to move Thomas into a new position or into a
Lateral transfer.
Lateral
transfer.
that's been approved by the board.
Yep.
Good.
Now we need to.
And then we need
temporary
a
adjustment.
motion to increase Thomas's wage. Increase his base salary by the equivalent of $6,240 per year.
He's not the only one though.
But the other one
That's,
is.
the
The other
other
one
one
is-
doesn't matter.
The other one's
The-
classified.
Is classified in the
I
executive director.
I would second that motion.
Right,
Okay, got it.
Got it?
You seconded it.
She made it, I
Okay.
seconded.
Terry
Right.
made it, Maggie seconded.
right. And then we only need it for Thomas because we set the compensation amount for exempt staff. The other staff who's going to get a raise just falls within the executive director's purview. Does that make sense, Mark? Okay. Any discussion? If not, all in favor, say aye.
Aye.
Any opposed? None. Anything further from the HR committee? No. All right.
So one though, clarifying point is this adjustment to Thomas is for the period until the director position is filled.
Correct. It's
For
a
assuming
temporary
additional
adjustment.
duties.
Temporary adjustment for both.
Okay. That understood by everybody? All right. Comments from pension board members. Dan, anything from TRS?
Well, we have not met since our last meeting here, so I don't have anything specific. But I am going to meet later offline with John and get a little bit of additional information on some of the alt investments. And I'll bring back that to our board at TRS because there were some questions there. And then Sean Graham would like to see investment returns go up.
Well, they did in July, wasn't that good enough?
Okay, is there a motion to that? Or is there a motion to respond to Sean?
Oh, please don't.
All right, anything else, Dan?
That's it.
Thank you. Maggie, anything from the PE or
Yeah, we met.
Empower Board?
We met on June 9th and we had board elections. I was elected as president for the next year. And we approved some contracts with Agency Legal Services Bureau, our tax council, and our third-party disability examiner, who's doing a very good job, I might want to add.
Do we need to do a revised MOU for Ice Miller, or is it still standing? Okay.
You're talking tax council.
Yeah, because we signed that with you.
We signed a local government contract with the Missoula Irrigation District. We actually reviewed our board orientation manual. We've never really had one until now, and it's really going to be a nice positive thing for board members to know what their duties and responsibilities are. Because in the past, we didn't know what we were doing. So, just kidding. Just kidding. But we actually have a manual now. So the big thing we did was discuss the defined contribution deferred compensation plan fees. The DC plan is still on a holiday until June 30th, 2023. And the 457 deferred comp plan, we did not change their fees. And I didn't know if anybody wanted to know what the fees were that members paid, but I brought it. Last year, I think it was, we waived any fee for participation balances less than 10,000. In the past, they used to have to pay fees, and it seemed silly to me. And as a board, we agreed not to charge them. There's a $10 annual fee. There's an asset-based fee of 0.35% and an annual fee cap of 244 already in their accounts. So yes,
What is the rationale for the holiday for the DC plan?
it's because the plans were doing so well.
There's
Excess.
not excess reserves, but the reserves are sufficiently high that they don't. need
And
to-
we put money, and we put money back, the board, the staff didn't spend the budget, and that goes back to the trust fund.
But those are the fees they're paying to the Imperial board.
They're the fees that they pay for being a defined contribution.
They're the Empower and Impera
Yes,
fees,
Empower.
not the individual manager.
Right.
Not the- Yeah, that's a good point. John brought that to my attention earlier. It's not the manager's fees, it's the Empower.
Anything else?
I don't think so. I think that was it.
All right. Any questions? If not, we'll move to tab 2.
I just want to know, do we have to call her Madam President or anything?
No, and I think it's also important to know that the Imperial board doesn't want.
I'm
Or at least they
okay.
didn't ask for
Doesn't want better returns?
They just want to have.
it. Oh, okay. I think Representative Walsh has joined us.
Good morning.
And if that's the case, do you have anything for the good of the order for as a legislative update?
Just make more money.
It's only you.
They're just so patient over there.
She knows we're long-term.
Yeah, no, we're all good at this end. Yeah,
All right, thank you. Nice to see you.
yes, sorry I wasn't there in person. That's just kind of the way things have been going here lately. So,
Right. All right, so with that, any questions for Ken? If not, tab 2, Executive Director reports.
All right, you have the monthly snapshot attached. First action item, at the request of the board is there's a memorandum budget proposal for fiscal year 24-25. At this point, based on health projections and expense projections, it does not appear that we need a rate increase in the subsequent biennia. This also ties in with the management fee structure changes we made earlier this year. So my request to the board is that we not increase our rate we charge to participants for BOI operations. We can manage. The one exception to that is all of those other state agencies that bill us for stuff. Department of Commerce, Department of Administration, elsewhere. I would request that if they have a fee increase, we just pass that through as they request. It's not our budget. It comes off the top. So that if there's an increase on indirects, that would be the only fee increase we would ask for, rate increase we would ask for next biennium.
Mr. Chair. So that, I had a little trouble following the second paragraph, but that's
Okay.
what that's about, right? You're not wanting to ask for authority to spend until you actually know what the fee is.
So what we've done in the past is we would set our rate.
Right.
$10, and then someone else would come in, raise their indirect rates, and it would come out of our operating budget. So what I'm saying is, we'll set our budget where it's at, and then if they ask for something, separate decision package, separate rate request
Comes on top.
goes on top.
And then we can raise our rate to cover it?
Yes,
Okay. And do you need legislative approval for that?
our rates are set by them, yes, so they set the ceiling.
So, but by the time that's set, we will know what the other agencies are gonna charge. Is that, I'm trying
So-
to figure out how this works.
What we had, that's the other weird thing about this is in prior years, we've set our rate. Then someone does a rate increase that we don't know about, or
Right.
last biennium. There's a position at Treasury that's now totally billed to us. Which means they're billed to you and state fund. We don't have any money that's ours. And that just came out of our operating budget. Department of Commerce increased their indirect rates.
Right.
That came out of our operating budget. So what this proposal does is when we submit our executive planning process request to the budget office, we set our rate, here's what we want. If anyone comes in with anything higher than their current rates, they can go ask for it.
So would you actually have some kind of a qualifying comment in the budget request that indicates this is our rate? If there are additional rates charged by any other
Yep.
entity or agency, then
Tack it on.
And we're well under the maximum, so it's not an issue if that's higher than we expected, or.
For this year, this
Generally.
biennium, we've managed it. Prior, we had some rough years there for a while where we were 15%, 20% overspent. That was like the first month here. So this year, because we've got expenses low and, as an example, travel's still not back to where it was prior. We did 200,000, or I'm sorry, 1.2 million. Peggy, I can't, I have it right here. Never mind. This year, we paid of the 8.789 or 8.815 budget for the biennium, we rebated 1.49 of that to the participants. So we had a 17% dividend payment to everyone. So our fees were substantially down from what our rates were. And that's after covering the treasury expense, after covering the Department of Commerce expense. So fees for everyone this year look very good from our side.
and travel was way down, but you're expecting that. to get back to
Travel's gonna
normal,
kick
right?
up. Travel's gonna kick up. And, yeah. I mean, snacks, you can't even afford those anymore.
So you're not changing your rate.
Right, the top line rate, we keep the
And then
same.
the rate is applied to what?
The rate is applied to assets under management. So we do
For
a
those
cost
entities.
for those entities through our cost allocation. So we've also changed our cost allocation in the last few years. It used to be just a flat across the board. We now bill based on the assets that each participant owns. So if you own public markets, you're charged for public markets. There are some entities that can't own private stock, so we don't charge them for Bloomberg terminals. Yeah, it's a different fee. So we've rebalanced. It's more transparent to all the participants. They're paying for what they actually have. They can look through and see what they're getting billed for. And now with the rate side, they'll also have the additional transparency, which I don't know that the board's ever seen these sorts of charts of. Here's where your money goes. 10% of our budget goes to commerce, 1% goes to admin. We're basically transitioning to a personal services entity, which is, in my opinion, a good thing. We're relying on our brain trust more than outsourcing that.
And then one more thing. So when you go to legislature, you're going with this proposed fee structure.
No, this is what we submit to the governor's office. The governor's office can then revise this. So this is just our submission for planning purposes. November 15th, they'll tell us what they've decided our rate is.
Okay, but then when you get your appropriation, or you say, here's the fee that we want to charge entities. But this is only our base operations. This does not include other charges that we receive that we're not sure of at this.
This
point.
is our base operations plus current fees from other entities. So this does not include increases to other entities' fees. So like if they go up 5%, the ask would be for the increment between current fees and new fees
Okay, so this proposal does include those fees
as they are today. Yes.
today.
Base, a base.
Basically, it's a base budget of where we're at today. Here's our base budget. We're asking for no new proposal for rate. And then if they have a new proposal request, we'll go and ask for that.
Would an example be maybe audit costs or something? Yeah.
Audit costs are automatic, so those get built in.
They-
off
they
the
fund
top.
those,
Yeah.
don't they?
So, look, I mean, the best, for us, the most pertinent example is Department of Commerce says your 14 rate, your indirect rate for commerce goes from 14.7 to 15.2. We'd go ask for that margin.
You ask the budget office for it, and then they know what commerce is. So when you go to the legislature, it's a.
It
unified-
balances out.
Gotcha.
Yep. And the other element of this request is, I already mentioned the classified position we're going to advertise for. We have the modified FTE. This would request the FTE become permanent, but with no additional funding. So that's also part of the budget request. Flat, we fund that position out of current budget authority.
You feel like you can do that even though someone's down this year? I mean, obviously, from the numbers, you can do it.
Do we assess fees on some of the loan programs and things away from asset management that are separate to cover those areas?
Right, so for enterprise, for the loan program, it pays for itself with its spread. So we only charge them for office rent, those sorts of things. For the loan program, in-state loan program, they're an element of the trust fund, so they get charged like a trust fund asset.
And then when we're required to loan money out at 0% interest rates, where's the spread on that?
We charge it. Great question. We charge a direct, we just charge for our time.
Okay.
So if, we created a special time code. And that's another reason why we were able to do the 1.49 in rebates.
Because
We
you
got
had-
additional revenues in. So we billed for our time against that as opposed to just the base budget. So I like doing things like that can offset the fees we charge to the participants. So now we'll have this hopefully permanent new funding source on an ongoing basis.
So it's not like the pension participants are subsidizing any of these other programs. It's all offset.
No.
Yep.
no.
Okay. So really, we're approving a budget based on the same percentage fee and giving you the authority to ask for more if the other entities of state government end up charging us.
Correct.
And the authority is limited to the amount that, the increment that the state entities charge.
Correct.
Okay.
And authorizing me to ask the budget office for one permanent classified
Right,
FTE.
right. Okay. Is, and we need a motion to that
I'll make that motion. Mr.
Second.
What is the motion?
effect. Are you serious? Do you want?
Just the basics. So we're approving, or we are.
You're
the
approving a-
base budget. And any addition, and the authority to add any additional fees as you become aware of them. And one permanent FTE
Correct.
with no dollars associated with it.
Let me put it in the political sense. No fee increase for next biennium, and we'll absorb one FTE
Correct. Unless
someone else raises their fees, then
somebody else in state government.
we'll let them ask for it.
Right.
That's a budget request you'd like to
Exactly.
take over to the government.
Anything else? Does everybody understand? Any comments? Public comments?
I do have one question.
Yeah,
So this
sure.
goes to the budget office. They can change things.
Yep.
And will you tell us if they do change things?
Yes,
And then another question is, so then it has to go through the legislative process.
yes.
So this is just a kind of a initial.
This is our
Just a
submission.
request.
This is our request. A lot more steps. Which I can't wait for.
Are you optimistic that something very similar to this would be the end result?
Yeah, there's, in this environment, anybody that's keeping fees flat they're gonna be happy.
Okay, anything else?
I'm good, Mr. Chairman.
All right. All in favor, say aye.
Aye.
Any opposed? The motion passes unanimously. Did you cover the status?
No, budget status is following the last page of the
Right.
pie charts. Just an update on where, we were under budget in all areas. From a spending perspective, things look good. We will wait on the policy adoption until the August 16th administrative rule meeting. We'll update the agenda for that. Item E, and then item F, I just attached for your information. We began the biennium with another study about in the coal severance tax trust fund and whether or not private capital stock should be added to the investment mix. That is a constitutional change. It's been ran twice, failed both times. Ultimately, where the committee landed after 2 years of study is that they will let the finance committee undertake 2 years of study next biennium. And no changes will be coming out of the interim committee. I think I showed you in the last board packet, there was sort of this desire to draw a straight line between the investment outcomes of the pension plan and state fund who have exposure to those particular asset classes with the trust fund, with very little understanding of the investment objectives, the time horizon, the purpose of the funds, all of those things that would change your asset mix and how you treat those dollars. And once the committee got a good understanding of, capital preservation is more of a thing for the trust fund than it is for pension. Not that capital preservation isn't important, but those agencies that live and breathe off of distributions from the trust fund can't really absorb a 20% 3-month shock in a budget. So no action taken, but I thought you might be interested in the report. This is now the final report. They didn't make any changes. So
Okay,
that is all I have for you, Mr. Chairman.
all right. I guess Representative Walsh, you have anything to add in terms of the coal severance tax study report by the Revenue Interim Committee?
To be honest, Mr. Chairman, I haven't read it. So I don't have any comment on that, but I think it's as the director said, Villa, that, there is different circumstances of what some funds are used for versus the other funds. And so I think, education and understanding, and then being it's a constitutional thing, that's a big leap. So to try to do much change there. So I'll read it, and then if I have comments, I'll get it back. But
All right, thank you. You anticipate getting a billing to do it anyway?
I doubt it. The fact that the report was issued in June of this year probably took a little steam out of any desire to go that route. But we'll see when the recession hits, and if it happens to be in January through May of next year, probably takes a little more steam out of it. I think the other driving force is if there's a desire to increase distributions from the coal trust, there is so much money floating around in state government right now. You know, the pittance that would come from dollar averaging in to some form of passive index fund versus the $1.9 billion ending fund. There's a lot of other buckets of cash to fight over right now.
Where does the impetus to do this come from?
So we talked about it a little in the past where the legislature has made policy decisions to drive down returns on the coal trust. So they decide you will have a loan program that lends at sub-market rates. And then they look around and wonder, why aren't we making any more money in the trust fund? And rather than look at, like we just said, that we had to do a 30-year home loan at 0.08% versus 3 or 4 in trust fund, it's easier to have the conversation of increasing revenue than it is to have the conversation about ending rate subsidies.
I guess I would also add we've made moves to increase the yield there by adding real estate, improve real assets at the last board meeting. So we, where we can, not in corporate capital stock, but in other areas, we've looked at things that hopefully will be incrementally additive to the yield over time and diversifying.
Okay. Anything else from anybody? If not, we're a little ahead of schedule, but
We do have a decision on policy.
no, we decided to,
But don't we have to do that in this meeting and say we're going to postpone that?
oh, you're right. Well, Dan mentioned it. I think we're gonna postpone it to give us one more chance to do a quick, not a big edit, but what do you call that?
Magnification.
Magnification.
A magnification. And so with unless anybody objects, we'll push that off to our next meeting. No one objects, so okay. So with that, we are ahead of schedule. And why don't we just stay ahead of schedule and break and come back at 1? All right. All right. Oh,
We're ready to go.
all right, we're back online, back on Zoom, back recording. We're at tab 3, new commitments. Ian, you're up.
Sure. Hey, good afternoon, everybody. I think everyone was here, maybe not Daniel when I came on board. Started in January, so been here 6 months, working on the private investments team. So,
A remarkable rise to power.
yeah, well, new opportunities. So,
What came from Cambridge and D.A. Davidson. So
yeah, I was actually at D.A. Davidson in Bellevue. So we can chat about that later. But yeah, I was out in Boston. Went to school in Missoula. Went out to Boston, worked for Cambridge Associates in their family office practice. So,
You left out the over-the-road trucker part.
oh yeah, I was worked for Watkins and Shepherd in Helena in 2009. Drove the lower 48 for them for a couple years. Then started doing less than truckload for Redaway in Missoula while I went to school. So CDL to CFA, that's what I call it.
which was harder?
You guess. CFA. So anyway, I'm hopping into private credit. This is what we've been doing the last few months. We closed on June 13th, $75 million commitment to Treeline Direct Lending 3. This is a re-up to a fund that we know really well. We're LPs in Fund 2. We did 50 million in that in 2019. It's tracking really well. 12% net IRR for the pension. So really happy with how those guys are running the portfolio. It's senior direct lending. Fund 2, the entire portfolio is performing. We really like the space, especially in the lower middle market. They originate direct loans to small companies, call it $50 to $100 million total enterprise, 10 to 20 million EBITDA companies. They're typically the only lender in those situations. It's a great, we like lending to the lower middle market. The larger credit funds that are raising billions of dollars, they're not competing for these size loans. Treeline typically does between $5 and $20 million loans. The billion-dollar funds like Ares or Golub, they're not gonna spend the time originating the amount of loans they need to do. These guys stay pretty small, raising $250, $300 million funds. Also, if you play in that lower space, more favorable terms, strong covenants, they're getting about 5 to 8% coupons. They structure them a spread above LIBOR. Don't do too much equity participation. These guys are really your kind of sleep well at night lender, where they really go into the operational history of the companies, get to know the management teams, very rigorous on that front. They're never gonna compromise on the credit. I was just at their virtual annual meeting, and a lot of questions about, hey, recession, what does the portfolio look like? Are you guys doing anything differently? My main takeaway was they said, hey, since we started the firm in 2014, every loan we originate is with the expectation that next quarter we're going to go into a recession. So they went through all the different ways of stress test the portfolio, and things look really good. It's a great risk return profile. We're in the first position. They're targeting 10 to 12 net. The fund is leveraged at the fund level, but the portfolio companies that they lend to are below market on their debt levels, usually around 3 to 4 times EBITDA debt, compared to maybe 6.5, which is market. They only do sponsored lending, so that means they will only lend to companies that are backed by a private equity sponsor. So if the company goes into a period of distress, something unexpected like COVID, a lot of good businesses where EBITDA took a huge hit, they use the PE sponsor as a shock absorber. So they'll go back and say to them, hey, you need to recapitalize the business, add more equity in, keep the company afloat, or get them out of default status if the trip covenants, whatnot. Otherwise, they are in that senior position, so they have a lot of legal protection and they can foreclose on the business and force a sale to get paid back. So there's not many examples of that. Treeline, to demonstrate how good they are at that, their loss ratio is only 0.5%. Average in the private credit is about 3.3% loss ratio. So well below market on that. The GPs, John and Tom, have worked together for 18 years. Started off at GE Capital and then another asset manager called Medley, doing the same exact type of lending, direct loans to small companies. So we really like their background. They bootstrapped this company. So pretty young guys, early 40s. And they have a great reputation in the industry. I mean, they've been in it for 18 years now, and that's where they're really getting their deal flow from. A stat to throw out there is about 2/3 of their loans are with repeat private equity sponsors. So, the PE firms like working with them and using them to fund their add-ons acquisitions. So they get a lot of repeat business there. That's kind of that flywheel effect that they like to talk about. So to kind of wrap it up, economics, you'll notice on the board brief here, we've got some pretty good economics. Negotiated the management fee down to 65 basis points, carried interest 10%. So that just speaks to our partnership. We're big LPs. We increased our commitment, and we think that's a great sign on their part. We see this long-term, so do they, and so we were pretty happy about that result. So I'll stop there.
I asked, 75 million, how do you determine that that's the right figure for us? For somebody like this, so we've got a history.
Yeah, so it's larger than what we do for just a venture and buyout manager. I think that speaks to more of the risk level. I would say this is pretty low risk. Just the position we are in the cap stack, that if something goes wrong, and every once in a while it does, the amount of recourse you have to get your money back is extremely strong. And there's tons of case studies that they have where, you know, covenants were tripped, and the ways they're able to mediate that and correct the loan it's pretty interesting, pretty powerful. So I'd say, yeah, it's more just a factor of risk. And so we are comfortable having more exposure to one manager like that compared to, say, a VC manager or a lower middle market buyout company where it's more equity risk.
How does it work when you negotiate a lower carried interest or management fee? I mean, that's what they're charging us.
Yeah,
They're not, I presume they're not charging
no, I think we have the best economics out of any of their LPs.
okay,
If not the best, at least almost the best.
okay.
So to answer your question, we started at a lower commitment size. And then just as we were negotiating the legal process, we kind of just threw it out there and said, just to see, you know, what their thoughts were, saying like, I think we started off saying, hey, if we increase to 75, would you go to 50 basis point management fee? They said, hey, you guys are really valuable LPs, so it's at least worth us taking a week to think about it. They came back after a week and said, hey, we really can't, you know, underwrite what we're doing for 50 basis points, but we do 65. And then we went back and forth over the carried interest as well. So it's just kind of a back and forth, like, hey, what are you willing to accept? How much more are we willing to commit? And these are the terms that we agreed on. So I think they're pretty favorable.
Well, I've heard that you guys practice thinking, what would Jack ask?
I didn't practice that.
Oh, I was gonna say, what did you practice for me?
Yeah.
No.
Keep it coming.
I don't, probably because I don't understand, but I don't understand how you do a different carried interest and management fee for different investors.
It's based on size. Essentially.
What is he talking about, like the account?
Yeah, the accounting on
Oh,
that.
how do they account for it?
Yeah,
Well, every LP has a different capital balance that they keep track of. So it's European carry, so it means the whole fund has to reach the hurdle rate of 7% before they start taking their cut. So they would just calculate every LP differently based on.
oh, okay, so they take their, oh, okay.
Yes. They
So
would
if you're
take less,
10%, and then they, so the, and the other, and everybody else is at,
13.75.
yeah, well, that's it. Everyone else is at 15, let's say. They
Yep.
take 15% from everybody else, but the lower amount from yours.
Correct, yeah, once they get into the carry, so meaning the fund has an annualized IRR of 7%, then every quarter where there's profits, they're gonna take 10 from us and take 15 from the other
Okay.
LPs, yeah.
How transparent are those records among different participants? How
Yeah.
would you know what the range is?
Well, so we have a new policy where we use ILPA fee templates. So the International Limited Partners Association, they provide a lot of guidance on how this is reported. So every single quarter, all of our GPs send this to us, and we have a new process now where now that's getting uploaded to Slovus. So you can immediately go in there and really calculate how much is being charged against us. So it's pretty transparent on what they're charging us. But are you asking more like, how do we know if someone else? I guess I don't know exactly how, because we're not auditing. Maybe you can speak to
I
that.
can jump in. The first provision we negotiate in all of our side letters is called a most favored nations provision. And by virtue of that, they disclose side letters, all side letters to us. And these economic terms
Sure.
are generally laid out. These different economic terms are usually governed by the side letter, which is a supplement to the limited partnership agreement. And that's not always the case. We don't, in our position, we always get every side letter. Most GPs don't always disclose all side letters, and it's based on your level of commitment. But as a standard operating procedure, if they are not going to be transparent with us and disclose everything, then we just simply won't invest with them. We understand that there may be different size investors that are bigger than us and get an even better economic deal. And that's great. They're investing $300-400 million. Fine, go get a better economic deal. We just want to know what that is. And so we demand that transparency in every deal.
And as a follow-up to that, how much due diligence, how much, do you have enough time to actually look into all of those records for every deal you do before you do it?
Absolutely. Yeah, hands down. Hands down. We, in conjunction with our counsel, our outside counsel, look at every side letter that has been entered into contemporaneous with our investment, prior to our investment, and then subsequent to our investment. Because we're not always, we may be in the first close or a second or third close, or we're at the last close, in which case we see them all before we commit. But if we're first closers, we won't see, well, we will see subsequent closers, but we just won't see those when we're committing.
Thank you.
And what kind of pushback do you get when you make that request? I mean, obviously, these guys are used to dealing with us, so probably not much of a pushback, but what happens when you go in a new fund and you say right off the bat, we want to be your most favorite nation?
Well, so there's no pushback on an MFN ever. In my 15 plus years experience in hundreds of funds, had across organizations that I've worked with, I've always had a most favored nations provision. It's very standard practice in the industry. The pushback comes when you say, we want to see everyone's side letters. And they say, well, you're only a $50 million investor. I'm not going to show you the terms I gave our $200 million investor. And I say, thanks, have a nice day. See you later. Our capital is worth more to somebody else. So those circumstances are few and far between, but they most certainly exist without a doubt. And, it's not worth it. Carl, you're entering into these deals with folks for 10, 15. I mean, the average fund life is plus 17 years, despite what the docs say, a 3-year investment period, a 5-year term after that. So, an 8-year total fund life, they go well beyond that always. 95% of the time, I'd say. And so if you're not entering the relationship eyes wide open, full open kimono from the get-go, like this is a highly commoditized space, and there are 100 or thousands of other firms, similarly situated that will gladly take your money and gladly be a much better and more transparent partner. And we're
And has
happy to
that
have those
changed over the years? Or was it always like that?
I'd say I'd say the LPs are probably a bit more in a more favorable position than we have been historically, just because there has been more pressure for transparency vis-a-vis ILPA and just LPs asking for more transparency and demanding it. But it's marginal. It's marginal. It's not like, sea change for sure.
And do they give you those,
Oh, for sure.
Yeah.
do they give you those side letters under a non-disclosure? You have a non-disclosure obligation?
Every single limited partnership agreement or LLC that we've ever been a party to has a confidentiality provision within it, not a separate NDA necessarily. And that's another maybe nuance point. We do not sign others' NDAs any longer and haven't for a little while. We have our own NDA that we redrafted with the
Right,
help
right.
of Dan White, who was super instrumental in that. And so we'll ask them to sign our NDAs. And again, I guess if somebody is reticent to sign ours and pushes the issue for us to sign theirs, that's not a good starting point, and I'll move on.
Yeah, so we definitely look at these as long-term relationships, and so right off the bat, if there's, pushback, resistance, you start, even if you just get a weird feeling in your gut, that's like a pretty good, indicator to just, like Ethan said, there's a lot of good GPs out there, just, go start a partnership with somebody else. Anything else on tree line?
Anything else on tree line? I'm supposed to ask.
Oh, sorry.
Regarding his turf.
Turning now to Marcus Capital.
Okay, Marcus Capital Partners Fund 4, that is a new relationship with, for us. Marcus is a vertically integrated operator focused on sort of the northeast corridor between DC up through Boston and New York. They will be focused on industrial, multifamily, and life science specifically, approximately a third. They've been in business through cycles. Paul Marcus, the head of the firm here, the principal, has been in business for 40 years. He's operated through cycles as Marcus Partners on a standalone basis. He's got, a 0% loss ratio, has an extremely attractive track record. He's been through multiple cycles, he and his team. Just a great operator. Actually, a little bit of a funny story. I cold called Paul the day before, 2 days before the lockdown. And so we've been talking about this for the better part of 2 years, 2.5 years. And we finally brought this to the finish line just back in May, I believe. And so very happy to have this as an addition to the portfolio. They'll do a mix of just classic value add repositioning, releasing. They'll do a little bit of ground up development to the extent it makes sense. But just a very, very tried and true cycle tested, deep team, and a great add to the portfolio from sort of a geographic perspective and a little bit of life science from a portfolio construction.
And what is
perspective.
life science?
So life science, just think of it as an office building that is 80 to 90% lab space for drug development, and the rest is, going to be office space or a boardroom for people to write on whiteboards and stuff, but largely labs for drug development and discovery and testing.
When I look at the preferred return of 6%, that's under what the pensions want us to get. How do you justify that?
Sure. So the preferred return is, think of it as a hurdle rate. So before they participate in their profit, they have to earn a minimum of 6%. And in this case, it's what we refer to as a hard 6. So once they've hit the 6, in many cases, they will take a disproportionate share of the profits to catch up to 20% of the distributions on sort of a disproportionate basis before it shifts back to our favor. In this case, it's just a flat 6. We start sharing 20/80. And so it effectively, instead of diluting the IRR, it doesn't dilute the IRR. And we actually spent some time on this and ran through a pretty heavy analytical Excel model scenario, ran a number of scenarios. And we had the option to go with an 8% or a 6%, an 8% where there's a catch up, where they get a disproportionate share of the profits and distributions after they hit their hurdle, versus the 6% hard where we just share 20-80% going forward. And assuming, all models have assumptions and inputs and so forth, but assuming I think it was 11.5% net return, this model was the better outcome for us, economic sharing arrangement. So we opted for that.
So the catch-up, I don't understand.
Yeah, so, okay, so you've got an 8% preferred return
Right.
in a European waterfall, which means we need all of our money back plus an 8% return over the life of the investment before they start participating in any profit participation.
Right.
So assume they hit that 8%, there's this mechanism in most limited partnership agreements, it's called a catch-up, where the GP will then take 80% of the future distributions after that 8, and we'll only get 20% of that until they catch up to 20% of all distributions to date. Yes. Versus, so that's the catch up. And so all of a sudden they get a bunch of the capital after the 8% and we're only getting a little bit. So our IRR is getting diluted through time versus if they just hit that 8% and then all of a sudden it's just, we're getting 80% of the profits versus them getting 80% of the profits and us getting 20, we're getting 80 and they're getting their 20.
Okay.
It's sort of flip-flopped. Does that make sense?
Yeah.
I can explain it again if it's unclear. It's a little bit of a complex issue, but it's a better deal for us, rest assured. Assuming they hit their targeted rates of return, which there's never a guarantee there, as we all know.
Ethan?
Yes.
That's calculated over the entire life of the investment, not annually? or something
Yes.
like that?
Yep, that's correct. Yeah.
And what's the difference between European and whatever the other options are?
Yeah, the other option is what we call deal by deal. So the European is whole fund, so they look at it over, they look at the whole fund versus, oh, I just sold a deal and that deal made some percent over the 8. So instead of taking the profits on a deal by deal basis, based on that, 8% preferred return and the 20% profit, they have to return all of our money to us and the 8% before they participate, just as opposed to returning all the money on that one deal and the 8% before they get the profit. Does that make sense?
Yes.
Okay.
So from an accounting standpoint, are we showing just a return of principal until the very end of these deals and then we get our profit? at the end?
No, not necessarily. That's all based on the capital account and the composition of what has accounted for the capital activity in that account during the quarter, which they report to us. So it could be a composition of both principal, income, or return on, if all that makes sense.
Anything else from anybody on Marcus Capital?
But to your point, Dan, I think we need all of our original principal capital back and a return on that of 6 or 8 or 7.5 before they participate in anything.
So do we
All right, that
prefer
makes
the
sense.
European then over the deal?
Absolutely,
Looks like it when
absolutely.
I'm reading the definition
Yeah.
here.
Absolutely.
And is that negotiable or is that
The
the
preferred
way
return,
is that the way they set it up?
everything's negotiable.
Right.
But
I mean, are we in funds where we're deal by deal and other people are European? That's my question. Or vice versa.
Probably not. Probably not is the answer. I don't know with 100% certitude, but it's
Right.
highly unlikely that that would be the case. Extremely unlikely.
So you're saying if one was deal by deal, they'd all be deal by deal?
Yeah, everyone ought to be subjected to the same, because that's a pretty significant provision
that's what I
within the
was wondering.
LPA, and
Yeah.
that's just not going to happen.
Anything else? AEW Cold Storage.
Okay, AEW Cold Storage, excuse me. This is a fund. This is a new relationship for us as well. We committed $80 million through CAP, $50 million through trust fund. It's got a sort of a core plus orientation, which means that it's got a little bit of a flavor or an aptitude to do some ground up development, 10 to 20%. Most of the fund will be focused on stabilized properties, 50 to 70% of the fund with, fully tenanted, tenants paying rent. And then another small portion that will focus on converting dry storage or industrial buildings into cold storage. But essentially, these buildings that they're developing, purchasing, et cetera, converting, are focused on the manufacturing and transfer of perishable goods, be that, pharmaceutical products, food, flowers, candles. I mean, you name it. It goes far beyond just food and so forth. This is a little bit of a story here, and I'm happy to share it. Scout Cold Logistics, you'll see Vincent Cingarello is the CEO and founder of Scout Cold Logistics. That was purchased and brought in-house by AEW, and so it's a wholly owned subsidiary of AEW now, which is sort of your more classic value add allocator. They had a long history doing deals with Scout and really liked the space, liked the team, and ended up buying them and bringing them in-house as AEW's first fully wholly owned, vertically integrated real estate strategy. And it just happens to be specifically focused on the cold storage space. And so think of this as a vertically integrated cold storage owner operator that's wholly owned by a very large and long existing real estate investment management firm.
What does evergreen mean in this context? Is that the fact that it's staying cold so things will stay alive?
Not quite. It more refers to the term of the fund itself. So the term, there's a 3-year investment period and then a subsequent 4 or 5-year fund term. And then the tranche, so it's what did I just say? I think a 9-year tranche that can roll over into additional 9-year tranches instead of sort of having a finite life and wrapping up at the end of year 9. We can continue to roll.
But we make the decision, you make the decision.
That's right. That's right. That's right. We can opt to roll. We can opt to roll and reinvest new money, or we can opt to say we're not going to participate. We're out.
You thought it was a flower thing.
Well, I would he was just talking candles, flowers. I thought, well, maybe.
So, so that 9 or whatever it is years, then that, for us, that can be a real hard number as opposed to the other funds where
Well,
said they don't.
yeah. I'd
They
say it's still theoretical, Carl, because look, let's face it, these are illiquid markets. These assets, depending on capital markets, et cetera, are easier to sell or buy. The buyer pools are bigger or smaller. But I would say at the outs, if we didn't want to reinvest or roll into the next tranche, our equity position, conservatively, we'd be in for another 3 years, which is pretty typical of a standard fund that even extends beyond its normal term. But I will tell you in all honesty, our intention is to be in this very long term. That's part of the reason why there's a heavy income orientation here, a pretty high current yield component. That's partly because it's still a very fragmented industry, or property type. Very fragmented owners. These assets are pretty unique and mostly are owner occupied, and the owners actually had to hire someone to go out and build them 30 or 40 years ago because they needed a specific building to fit their business model, and nobody was out there doing it, on a large scale. So coming back to, this is a very unique product that is growing in institutional recognition and ownership, and there's more capital flight into the space. And these guys are a bit of a first mover, to be perfectly honest. I've looked at a couple of other funds, and there's literally only a couple of other funds out there, and the other ones I wouldn't touch with a 10-foot pole. These guys have been operating in the space for the better part of 10 or 15 years. They can develop it. It's a very technologically specific operating asset with cooling systems and ammonia and hydrogen exchangers. And we've toured some assets, and it's pretty, they're difficult to build. You have to have technological expertise. These guys have a very good reputation in the space, are a preferred builder, buyer, et cetera. And this is meant to be a very long-term hold for us. I almost view this as a perpetual holding, notwithstanding some major macro market shift that would be, in my view, probably a 6 standard deviation event, but or a black swan, but this is going to be a long-term hold for us.
How does the 130 million compare to our other sizes? You know,
Sure. So I think most of our core positions within pension fund were sized right around 80 to 90 million. We've been selling down, and I'll talk a little bit about that later, but we've been selling down some positions within the core. So now there's a couple of core positions that are smaller than some of our trust fund positions. So for example, I think American Core Realty is down to about 50 million in pension and is 100 plus in trust fund now. So they're a little bit all over the map right now. They had been historically sized pretty evenly. But we sized the pension fund commitment here to be sort of in line with our core holdings. And we sized trust fund to be in line with the initial positions we took in core funds within trust fund. Those positions have since grown and appreciated quite a bit. I think I answered your question.
right, I was just trying to figure out, so it's a new relationship, and it seemed like a lot of money to put in a new relationship, but given the history and everything, it sounds reasonable. That's all I was.
Yeah, and I think too, we looked at it on a risk basis too, Terry, because it's sort of a core plus. It's a more income orientation, more downside risk. It's a highly demanded product. The leverage profile is pretty moderate. It's not, we take a pretty moderate approach to leverage, a conservative approach anyway. And so that had something to do with it as well. And I think just also because we want it to be a core holding and it throws off a lot of income, we sized it bigger.
Okay,
So this is a new relationship for us, but the company was founded in 1981. What took us so long to find it, or have you been trying to get there?
Yeah, no. So I've known about AEW my entire career. I've invested with them before, so that gave me some comfort. The reason why we haven't invested with AEW in the past is because they are a diversified allocator that has a national footprint. And so what that means is they'll invest all over the US across property types, except for cold storage, and they'll do it with local operators. So basically they're the capital provider, providing 90%, 95% of the capital to a deal where the local operating partner in Wichita, Kansas, for example, put up the additional 5 or 10%. And we don't need any more diversified allocators. We've got DRA, we've got Angelo Gordon, we've got some really exceptional diversified allocators in our portfolio. And we'll always have diversified allocators, I think, for that reason, because they've done so well through cycles. But we have a clear bias for vertically integrated operators that focus on either a specific property type or a specific market. And this is AEW's first go into vertically integrated operators. And so as soon as this product came across, I was like, oh, let me have a look.
Okay, so this is so when it says cold storage infrastructure, you're talking more than just the facility. Movement and that sort of thing, or is
I don't mean that to be misleading. It's part of the food distribution network, but it is largely just the facility. A lot of these tenants that are in these facilities have their own fleets, so they'll distribute it as well. But they're just a part of the overall supply chain. Some of them are completely vertically integrated themselves from, we looked at a building that was occupied by the largest flower grower in the world. And they not only controlled their fields, but they controlled all their distribution and storage and packaging and e-commerce. And I mean, it was a very impressive operation. So they're part of the overall perishable goods distribution infrastructure, if that makes sense.
And this is all North America.
Correct. Notwithstanding that, they would grow, they have a 10% bucket to grow into developed markets, probably Canada or Europe, but they would only do that to the extent one of their existing tenants wanted to grow their footprint, and they would only do it on a pre-leased, pre-negotiated deal with a current known quantity.
Anything else?
I got just a couple. Ethan, is this a hard hurdle rate or is this the kind with a clawback?
Shoot, Dan. I think this is a hard hurdle. I can get back to you on that. I don't think there's a catch up on this fund.
Okay. And then when it's evergreen like this, after you've met that hurdle and we're done with whatever that looks like, it's just 80-20 forever, or does it reset at some point? You get a new.
Yeah,
hurdle?
so at the end of the first tranche, we will pay them 20% of the profits, of which 50% is paid out in cash right at that time, at the end of the tranche, and the other 50% rolls into the next fund, the next tranche, and is subsequently paid out through time. And so it's reset at each tranche.
Anything else? Dan,
That answer, did he?
your questions?
I got so mad I threw my name tag.
Yeah.
By the time I come back, I'll have that hard hurdle question.
Yep.
answered for you.
Okay. Great, thank you, guys.
Thank you. Appreciate
Ian,
it.
nice job.
Yeah, thanks, appreciate it.
Ethan,
We'll see you in a little bit.
as usual.
Thank you.
All right. Tab 4, proxy voting,
Proxy voting.
presented by John Putnam. Chief Investment Officer.
Yes, let's dive into the exciting world of proxy voting.
My favorite topic.
Okay. Good, glad to hear it. Benchmark. Okay, well, proxy voting. Jump in and ask questions, of course, as always, at any point in time here, but I will jump off here on slide 2. So proxy voting, basically shareholder voting. Shareholder voting rights obviously allow stockholders to vote on issues that can impact company performance that come before the board, typically at the annual meeting, or perhaps in a special meeting. Proxy voting generally refers to exercising that shareholder vote by ballot or by appointing, somebody as a proxy because you are not going to attend that meeting in person, which is certainly typically the case for us. We do not go to all of the shareholder meetings in person. So typical proposals, well, before I guess I would say generally, and I'll talk about this a little more when we talk about our specific holdings later, but generally 1 share, 1 vote, but not always the case. There are certainly companies where the voting ability can differ by share class that are built into the company documents. So typical proposals include things like electing the board of directors, ratifying the auditor, advisory votes on things like executive compensation or other issues, approving mergers or acquisition transactions, and of course, shareholder proposals. Shareholder proposals are oftentimes what you see in the news most often, although as I'll share in a minute, they're not, the greatest portion of what is typically done in the proxy voting process. So why do we vote to begin with? Well, that vote is an asset like anything else that we have. And so we have a fiduciary duty as the Board of Investments to safeguard and protect those assets. It ensures that we and others have a voice in running the company. And voting is a part of the corporate governance process. There are any number of studies out there that show that, having good governance is linked to good performance and good financial performance with the company. And so that all kind of rolls up to, when we look at proxy voting, the primary objective here from our view is always, are we maximizing shareholder value? Are we going to give the participants and the beneficiaries and the plans or other portfolios the highest return over time over the long term? So that's the lens we're always looking at that. So if we turn to slide 3, a few statistics to throw at you here. ISS, or Institutional Shareholder Services, a proxy holding service. They put out some data here, 53,000 plus company meetings on over 445,000 different items in 109 countries just over the course of 2021. Quite a lot of activity, obviously. Over the last 3 years, for some Bloomberg info, 98.8% of the proposals that you see on a proxy vote are coming from management. And so most of those are kind of the, I'll call them, I guess, mundane, if you will, voting stuff like selecting the board of directors, things of that nature. It is important. So obviously the other 1.2% there coming from shareholders. I would note that pretty much any shareholder can submit a shareholder proposal. The bar is not particularly high. That hurdle, if you will, is set by the SEC. Basically, you've got to own a few $1,000s in stock for a period of time, whether that's a year or 3 years. If you meet that hurdle, you're allowed to submit a shareholder proposal, and management needs to put that on the proxy to be sent out to all the shareholders to vote on. So you don't have to own, 10% of the company or something like that to get something on the proxy. Board of Investments, just within our domestic equity passive portfolio, last fiscal year, we had 7,600 plus issues submitted for a vote. When you think about that, we actually have 2 passive domestic equity managers. So obviously almost complete overlap there, but from an operational perspective, double that number in terms of the amount of ballots and issues that you've got to submit something to. So clearly, we don't have the internal staff to research and vote on every issue that comes up on the proxy votes. Historically, we have had our managers vote our proxies for us, so they are trying to maximize the performance and the returns that we get. And so, would generally be aligned with, how we want them to perform, maximize that value. But it is true, and I think we've talked about it in the past, that certainly there are occasions where managers don't agree. And you might have one manager voting one way on an issue and one manager voting another. Probably not, huge percentage of the time, but it does happen. And then finally, I would just note that ultimately, voting shares does not provide any direct economic benefit to the Board of Investments. We don't get paid to vote. It's just something that we're supposed to do as part of the corporate governance process. There's certainly an economic impact associated with some of those votes. If they're voting on a merger proposal or a takeout offer, something like that, there could be an economic benefit depending on how all of the shareholders vote, but there's no direct payment to vote in and of itself.
So John, quickly explain that in the context of securities lending and the
Sure.
funding we get there.
Yep. So securities lending, if you lend shares, you have legally transferred those voting rights to whoever has borrowed those shares. Okay, so we can't vote those shares if we have those shares out on loan. We do not restrict our shares from being lent so that we can always vote our shares. We will make a conscious decision. We're going to take the income from the lending. Now, we do have the right always to restrict those shares if we want, and sometimes we do. Generally at the request of the managers. They may, for whatever reason, think that they need to vote those shares. Or they probably more likely, in some markets, particularly in the international space, there are certain markets where if you intend to vote the proxy, you cannot trade your shares for, call it 30 to 90 days in some markets, not all markets. And so they oftentimes don't want to tie up our shares for that period of time. They want to have the liquidity and the ability to sell those shares if they wanted to. So we might opt out of voting in those types of instances. So there are instances where we may not vote, and certainly where we take the income on securities lending rather than voting the shares.
No question, securities lending, 200 million or so, is that what we make? Or am I way over?
No. Million and a half varies from year to year. I think maybe our best year was probably 2 million. It's, sort of picking up pennies in front of the steamroller.
And
Diane wants more, could you?
I know.
We got.
I know Sean wants more too.
Now
Yeah.
Diane wants.
Yes. Okay.
well, we do have the better split, so that number should go
Right.
up.
Yes.
Okay.
Yes.
But how much is on average?
It varies considerably. And
There are no shareholder meetings, not a lot lent.
No, so people want to borrow shares just to, they may be shorting shares, they may be doing a lot of other activities rather than simply, it's not necessarily about the proxy vote. And in fact, it probably isn't about the proxy vote most of the time. And I'll probably address that to some degree here too on the next page. So slide 4. This is the top 20 public equity holdings for the Board of Investments as of June 30th. And you can see in that column or second from the left there, I guess, market value of about $1 billion. And that's MBUI owned at the end of June. Contrast that with the market cap of each of these companies. And you can see out to the right, and this makes sense because we're basically passive and most of these names are domestic equity securities. We're about 800 thousandths of a company in terms of what we own. So I think it's fair to say that we are not the deciding vote on any particular issue that would come before pretty much any company that we would own. So that doesn't mean that we shouldn't vote our shares, and I don't mean to minimize it, but at the same time, we are not going to be the ones that move the needle here on any particular issue. Other thing I would note on this page, I mentioned at the beginning, kind of the different share classes and things. So if you look at the far left there, you can see Alphabet, 2 different share classes there. So that's Google. If you don't know, we've got Class A and Class C shares. The difference between the two is that Class A has voting rights, Class C has no voting rights. And you might be saying to yourself, well, what about Class B? Well, Class B shares are owned by the founders, and Class B shares have 10 times the vote of any other share. That's because the only people that own Class B shares are the 2 founders, and they control 51.2% of the vote with their Class B shares. So that happens and there's other instances of that here. Meta Platforms is similar. I don't remember all the breakdowns there, but that's Facebook basically. Again, I think Mark Zuckerberg holds shares that have a higher voting weight than everybody else. So he essentially controls things. Berkshire is similar. There's some different share classes there as well. So, those sorts of things exist, which ultimately gives us even less voting power when you look at the weight of our vote in some of these types of proxies. Questions on any of that? So turning to slide 5 then, a few upcoming changes for the Board of Investments. So we are, and Dan White just walked in a little bit ago and said, we're basically there. We have an agreement. We haven't actually signed it, I guess, but we will. It's done later today. It's done. We're signing up with Institutional Shareholder Services to do our proxy voting for us going forward. We are signing up for the Taft-Hartley proxy voting guidelines. I'll talk more about the details of that in just a second, but in terms of signing up with ISS, the benefits here are we're outsourcing a very labor-intensive process, of course, that we simply can't do. We were already outsourcing it anyways to our managers, of course. Reporting is vastly improved. So we get reports from all of our managers currently. We can get all the information, but of course they all provide it to us in different formats and all of that good stuff. And so it is, you know, certainly not impossible, but it's a little time consuming and difficult to roll all of it up and determine everything at sort of the entire portfolio level. So that will be certainly a very nice benefit. ISS provides us some research in terms of how they're voting all the various issues. If we want to dive into any of that, they will kind of give us, you know, pretty deep color on all those types of things as to how they're doing things. And then there's a consistency there, which again, we've talked about in the past. You know, managers may be voting against each other in some instances. And so that wouldn't be the case under this parameter. Couple other things I'll mention before we talk more about the Taft-Hartley. So we're moving to separate accounts for all domestic equities. That is not solely due to proxy voting, but it's sort of a nice side benefit. So if we're in a separate account, we completely control the shares in our accounts and we vote those shares, period. So that is helpful in most instances to move away from a commingled fund. You know, we're also moving to separate accounts, as we've talked about before, because we simply have more control. We control those assets. We're not beholden to, you know, other people that are in that commingled fund with us who may be entering or exiting and possibly disadvantaging the rest of the commingled participants. So we don't have that problem. That's the biggest reason the proxy voting is a nice benefit as well, though. And then the other thing that's happening is BlackRock, and they're the only ones I know of that are doing that, at least at this point, within all of their commingled funds, they are going to allow the commingled participants to vote their own shares. So if we own 10% of a commingled fund with them, we get to vote the 10% that we own within that fund. Everyone else, at least that I know of at this point, you know, that manager would just vote the shares in a commingled fund. There's obvious reasons for that happening. You've all read some of the press type stuff. They're responding to that to allow people to make that choice. And we, of course, have signed up for that going forward. So that's good. And the reason that matters most is because in domestic equities, we are able to go to separate accounts across the board. It's not a problem. In the international space, we still have a commingled fund with BlackRock for our passive exposure. We could do a separate account, except that it's operationally very difficult. So within the variety of countries that are in the index, you have certain countries where it's expensive, it's difficult to access. You've got to have a lot of sub-custodian relationships, tax relationships, all of these different things. India is a very good example there that most people don't want to participate in India directly because it's just so hard to do. BlackRock being a very big player, no problem. They'll do it and they'll do it for us, and we don't have to deal with any of that then. So,
John, when you're saying we can vote our own shares, meaning that we now have ISS voting our shares.
ISS will
So
vote
we're
them for
not
us.
voting any of our own.
We're not voting any of our own. ISS would still do it for us, but
Yeah.
prior to this happening, BlackRock would have voted all the commingled. So, and that's a relatively new thing within the last 6 months, 6 months of that.
Is there a free option? We don't pay, doesn't cost us anything to have the option to do that, to select that.
Oh, to select the commingled, to vote our shares in the commingled fund?
Right.
It doesn't cost us anything. No.
Okay.
Yes.
How about to buy ISS? I don't need a figure, but minimal.
43,000 a year.
Oh, I'm glad I didn't get a
Figure
figure.
less than that.
Yeah.
I mean, that's the thing is
It was
by,
less
you
than we
look at the
expected.
cost benefit, the number of staff we need to go vote all of this ourselves and sort through each and every
Not even
versus
close.
here is the sleeve and the metrics that John will walk through here in a minute of how we're directing you to vote.
Right.
Not even in the same ballpark.
We get options or do we do what they do? You actually get a menu of options.
So
that
we
can
get,
check?
so we get options.
Oh,
So we've picked Taft-Hartley purposely. So why did we pick Taft-Hartley and kind of what's the other menu of choices, I guess, that we're picking from in part? So if you look at ISS, they've got, a menu of different things that you can pick from. So they are things like, the sustainability guidelines, the climate change guidelines, socially responsible, faith-based, board aligned. And then they have what they call their benchmark guidelines, and then they have Taft-Hartley. So some of those are pretty obvious. It's why we didn't pick those. But really the main reason we picked Taft-Hartley is because, so Taft-Hartley is aligned with ERISA standards. So the Employee Retirement Income Security Act. ERISA is a federal law that basically sets minimum standards for retirement plans to protect the participants. We are not subject to ERISA as a state plan, but the ERISA law is aligned with fiduciary standards and aligned with always voting shares in the economic interest of the beneficiaries, just as we were talking about earlier. And so from that standpoint, we feel very comfortable that, the decision that's made from that voting process is always based on what's the best economics for the participants. And that's, our fiduciary duty. It's where the ERISA laws land. And frankly, the Taft-Hartley proxy guidelines, when you look at those stacked up against all the other sleeves, they're the strictest in terms of being the most shareholder friendly. And so I'll give you a few examples of that within kind of the key parameters that I wrote out a few bullet points here. So that first one, 2/3 of the board should be independent, CEO and chair position should be separate. If you look at most of the other sleeves that they're offering, it would typically be half the board should be independent, and we don't have an opinion on whether the CEO and board chair should be separate. I would wholeheartedly say, I want more independence on the board, and I absolutely believe that CEO and board chair should be separate. Now, that doesn't mean we're always going to win that, of course, because there's lots of other people voting, but that's how we would always then vote. Similarly, auditor independence and vote for auditor rotation every 7 years. They would all vote for auditor independence, but they wouldn't vote for the 7-year rotation, which again, I think is, sort of a best in class standard. Just think of Enron and Arthur Andersen, cozy relationship. How did that work out for either one of them at the end of the day? So it always kind of slants towards, in my mind, the clear best practice and best value that you would want for shareholders across the board. And if you want to look at it, I have kind of a big comparison that ISS put out that kind of gives you at least the high level of those different sleeves. You can go look at it on their website if you want to. It's very clear, sort of the way that they do it. Only other thing I would add to all of that is that if we want to, we get a year into this process and they came up with a different sleeve that we thought was more appropriate, we can switch that anytime. We're not locked into this Taft-Hartley sleeve. To review that every year, they'll come back to us and say, hey, we are making these changes this year or whatever, and we can always review that type of stuff. So not locked into anything.
But are we for a year?
We're not locked into for a year, but they would, they recommend that you stick with a particular sleeve simply because then from a reporting perspective, if you were switching back and forth, it's a little harder to determine what was driving that decision at, so they want you to stick with that sleeve for the proxy season for that year.
And are we signed up now?
Yes.
Okay. To vote or 0.0005% ownership.
Yes. Yes, indeed. No other questions?
This could be controversial, so this protects us, right? The best way we can.
Absolutely, I think it does. And when so when, I guess the other thing maybe I would throw out there for proxy voting broadly, certainly we've heard all the different opinions that are out there about any variety of things. And I think the thing that keeps us and this board safe is the focus on, we are going to vote in the economic interests of the participants and the beneficiaries. That, we're not looking through any other lens. And that's as it should be, because when you think about the underlying beneficiaries and participants, I'm sure they don't all agree on a lot of these issues either. And so I don't think there's any way we can make, votes based on ESG type things, political things, or anything else that is going to, make everybody happy by any means. And so this is the lens we should be looking through, and I think is all we can do. Yes, Bruce.
Yeah, well, because it seems to me that, while we may only have 0.000085 on Apple Incorporated, so we have almost no responsibility for the outcome. We have a lot of accountability from a public point of view.
Sure.
And, we're gonna be held accountable, even though we have very little to say about the outcome. And so the more rational basis we have for how the shares are voted, the greater defense we got.
And I think that's the driving force here too, to moving to ISS is, I do feel like for the most part, managers are going to be aligned, but it is difficult to, but those managers are all going to have their different opinions and different values there. And so that is a little harder to particularly defend if they're doing particularly different, two managers doing different things or something like that. I think this is a much clearer and coherent and defensible message that, okay, this is how we're doing it.
This aligns with what the Constitution tells us we're supposed to do.
Absolutely.
Do the managers want to vote? When we tell our managers, you're not doing this anymore. We're having ISS.
We've already basically told all of our managers, this is where we're moving, giving them, there's a slight modification to each of their contracts to tell them,
Right.
hey, we're gonna vote our shares now. Everybody's been on board with that. They fully understand that. I would say the only pushback really that we've probably gotten is the type of stuff where say the international managers are saying, well, hey, we don't necessarily, we have liquidity concerns in this particular market. So we prefer if you didn't vote shares, because otherwise we're locked up for 90 days on that stock that we own. We're going to respond to stuff like that. Absent those types of issues that are, clear liquidity or economic issues that may exist where we wouldn't want to take a vote. It's just going to be, this is how we're doing it. And
All right.
no wiggle room.
Jim on this.
What's that?
Jim, I guess for Jim Voitko, how do we compare to some of your other clients in this space with the decisions we've made? Are we in the mainstream as far as how we're approaching this?
You are squarely in the mainstream of those asset owners and fiduciaries that focus exactly as John said on a tight focus on the economic benefits to the beneficiaries. The fact that ISS and several of the other proxy advisors and managers who would do the same thing that ISS has, have other sleeves that focus on global warming or diversity or whatever, are an indication that there are fiduciaries that are adopting those aspects to their proxy voting. But no, you're in the mainstream, and we look at this as a very rational decision. We've discussed it with Dan and with John. And the other thing is, while the name at the top is Taft-Hartley, as John pointed out, you might substitute this for the title of this for the most ERISA influenced or ERISA centric sleeve or voting policy. And in that respect, it's generally a good thing because ERISA is more strict. And even though it does not, as John said, apply from a legal point of view to your fund, it is a very strong benchmark, even for public funds that ERISA does not govern. So I'll stop there. I hope that was responsive.
Thank you.
Others? Thank you. All right, let's see, what do we got here? We're ahead of schedule. Want to take a break and get Jim in 15 minutes?
Yep.
Okay, Jim, does that work for you?
It absolutely does. I like
All
a
right.
break. I'm
We'll take
feeling
a-
lousy anyway, so that's okay with me, but I'll be ready.
All right, well, we'll be back at 2:25.
Okay.
That work?
Yep.
We're back. All right, we are back and we are up to tab 5. Report from RVK. Jim,
Well,
you handling this all by yourself?
I am, and I apologize for not being there in person. I had planned to, but the dark side of Mother Nature intervened, and so I'm remote. I apologize for that, but I'll do the best I can. But yes, I am
Dark side of Mother
I'm
Nature.
without adult supervision.
What's the dark side of Mother Nature?
The dark side of Mother Nature is the kind that puts you in bed for 24 hours and doesn't want you to get out.
Oh, I'm sorry to hear that, Jim.
Yeah, well, that's life. What are you going to say?
I hope you're feeling better.
All
right, take it away.
Putting it all together just for you guys, right here, as we say. Okay, I'm going to switch gears a little bit and throw you a curveball because I'm going to do something that I generally don't do. Generally, we don't like to focus this board's attention on the most recent 90 days of fund performance. It varies too much all over the lot, and it doesn't carry a lot of information with it. It's like evaluating a baseball player based on his last bats in a single game against just one pitcher. Baseball's got a long season and it's a perpetual sport, I hope, because I love it. Institutional investing is the same, just with bigger consequences. That said, I am going to, at this point, depart from what we consider best practice in board fund monitoring today and focus almost solely on the first 6 months of 2022. Now, why would I do such a thing? Why would I go counter to best practice, so to speak, in our minds in terms of board fund monitoring? Well, the answer to that question, I think, would benefit from a little flyover of major capital market declines over the last 25 years or so, and I'll make it very brief. It is a flyover. And that is that it's obvious to everyone and evident in the performance report that you have in front of you that returns declined notably in the first 6 months of 2022 and declined particularly in both of the two largest exposures in most multi-asset class funds, like the boards, equity and fixed income. But the characteristics of this market decline are not necessarily seen in all other material market declines. Sometimes in 2000 to 2022, the telecom blow up, fixed income performs far better than equity during the decline. Sometimes during the GFC, 2007, 2009, the great financial crisis, some of the fixed income markets declined quite strongly along with the equity market, but not all parts, in particular, mostly the treasury market. And the COVID decline of 2020 also showed that equity and fixed income don't necessarily decline together. The lesson that I would like to bring to you from this I guess it was more like a minute and a half summary of market history, is twofold. One is every market decline has its own drivers, its own color, and its own characteristics. And every market decline has different effects on a multi-asset class portfolio, such as the one that the board oversees. So what's so special about the characteristics of this market decline in the first half of 2022? Well, it is the first largely inflation-driven decline that we have experienced since the late 1970s. And I'm the only person, I think, in this conversation that participated in the late 1970s in institutional investing. And it was a terrible time. It was more than 40 years ago. Neither our multi-asset class portfolios of today or we as investors generally who have built them have experienced this kind of environment where there's a decline driven largely by a spike in inflation. We can debate the causes of it, but it hardly matters. Inflation is affecting the values that we see in the capital markets in both equity and fixed income. Indeed, there's a compelling evidence that a rising high and inflationary environment may be the single most poisonous environment for institutional investors, precisely because it adversely affects almost all asset classes. Now, if you own stamps, if you own antique furniture, if you own some real assets, and you'll see that in your performance report, you'll do a little better in those areas. But generally speaking, the large asset classes that you have substantial exposure to as an institutional investor do not fare well during inflationary periods. So when we look at the first half of this year, this unusual environment where inflation for the first time in decades has caused a market decline, we saw that both stocks and bonds fell sharply. During this period, the S&P 500 fell almost precisely 20%, and plain vanilla bonds fell about 10%, but long duration bonds fell even more, much closer to how far the equity market fell. In fact, during roughly a 5-week period inside that 6-month period, I believe there was a time frame when the US stock and bond markets fell in tandem more closely than at any time certainly in modern capital markets history. So that makes it unusual. And so it is a reasonable question for us to ask, how did the board's portfolio that has been built and refined over the last 10 years and has performed so incredibly successfully, how's it faring so far? So far, 6 months only, in an inflation-driven market decline. So I'll give you a spoiler alert. The answer is not that badly, but there's a few caveats. So with that, I'm going to turn to the larger book. I'm going to also throw you a curveball and work from the quarterly performance report and not from the executive summary, because there's some numbers I want to focus on there. But I am going to revert to form. I'm on page 2. That shows the performance of the underlying pension plans and other funds that you're responsible for. Page 2 has public retirement net returns at the top left-hand corner of it. And typically, what I like to do is to walk through where we stand on 3 benchmarks: the actuarial benchmark, the internal policy benchmark, and versus peers, in that order, because that's the order of importance to the pension plan, and by the way, to the funders of the pension plan. So let's look at the first 6 months, calendar year to date. This was closed out as of June 30th. So calendar year to date would absolutely capture the first 6 months of the market decline. And as you can see, the net of fees, the fund using the PERS system as the example fell almost 10%, but outperformed its benchmark. Now, falling 10% is quite short of actuarial expectations, but keep in mind, if you look to the right on this page, you'll see that over 3 and 5 and 7 and 10 and 20 years, the fund has actually produced very good returns, either close to or in excess of the actuarial return, depending on the particular period of time you're looking at. So, it is unreasonable for anyone to think that in every 6 or 12 or even 2 or 3 year period, that there's a high degree of certainty that the actuarial benchmark will be exceeded by fund returns. So this is one of those periods. But as I pointed out, the fund actually outperformed its internal policy benchmark. You can see that by looking just at the calendar year date, that second column in of numbers, and you can see that the fund exceeded its internal benchmark by 3.28%. What does that mean? Well, that means that if the benchmarks, the performance of the benchmarks had been aligned precisely with the performance of the fund, they would have fallen 3.2% short of this number. But in fact, the fund fell 3.28% less than the benchmarks did. And that indicates, at least at the outset, that there's some good structuring inside your asset allocation and your asset class structuring. Now, I will say that there's a big caveat here, and we'll talk about the caveats over this short period of time when we move along. But again, short of the actuarial benchmark so far, hardly surprising in a market decline, in excess of the internal policy benchmark. And lastly, at the bottom of that group of, in the second panel, you'll see the rank for PERS, just using it as an example for the funds that you invest for. And you can see that the rank is 38th. Now, that doesn't compare terribly well with, say, your 10-year rank of 5, your 7-year rank of 27. But keep in mind that you have an equity-oriented portfolio. And keep in mind also that, that in an equity decline, an equity-oriented portfolio is likely to fall greater than many other peers. Yours did not, number one. And so that's a testament to the diversification that this board has built into its fund over as long as we've worked with you for is probably in excess of 12 years. It has paid off. I think the answer is quite clear. The other is that you may recall that I've told the story about the Zen answer to how you have a portfolio that ranks in the top decile of peer rankings over a long period of time. And that is by never falling into the 80th or 90th percentile. So in that respect, this is a contribution toward continuing a long-term track record of performing better than peers. Now, I always caveat that the peer comparison is the least interesting and useful because peers are doing different things in different circumstances with different risk tolerances and different pension plans. But I will say that there's nothing that you should be embarrassed about in the slightest or should be concerned about with the peer ranking, as it has been for the many years that we've worked with you. Any questions about that? Otherwise, I'm going to move forward to some of the comments on the asset classes.
Questions? Go ahead, Jim.
Okay, absent questions, I'm going to turn to page 9. We're going to look at some of the asset classes. The asset classes are essentially your teams. They're the ones that get the wins and the losses, and how you structure them matters a great deal. You have moved to if we look at the first one, domestic equity, you've moved to a largely passive approach. And we have said when you considered that, that was a strategy that made sense, particularly in the large cap arena, because it is so difficult to produce excess returns. But we also cautioned to say that that you could essentially ensure that you had returns very, very close to the benchmark, which, as you see here, are within 5 basis points of it. But what you can't ensure in a passive approach is what risks you're taking. And so one of the things that has harmed passive portfolios relative to active management in this particular period, the 6-month period, is that it began the period with a heavy concentration in what were called the FANG stocks. If you recall, they made up sometimes as much as 30% of the entire index, which meant that an index portfolio was really largely a bet on those stocks. And I will say that the index is still pretty crowded. But one of the things that happened to large cap index portfolios is some of those FANG stocks, and I point out Netflix and Facebook, now called Meta, have fallen on very hard times. If you pull up a chart of either one of them, it's not a pretty chart. So finally, after dominating the market for many years, that group fell apart. Some members of it, like Apple and Microsoft, are hanging on, and Amazon and Google pretty well. So that's what's continuing the concentration. So there is some ranking risk involved in having a passive portfolio, but there's not active management risk, which is what you've decided to move away from. If we move down to core fixed income, I wanted to tip my hat to the core fixed income crew because these numbers in such a chaotic bond market, inflation really hits bonds hard because bonds are essentially investing in a stream of interest payments back to you. You're a lender. And those interest payments are largely, almost exclusively fixed. So they lose value when inflation spikes as high as it is. And it causes a tremendous amount of essentially disruption within the bond market because long duration begins to matter a great deal and can have wild effects. The longer you're locked into a stream of interest payments that you can't change, the more inflation harms their value. And so this is a very good performance during a decline that hit the bond market quite hard. You can see that by comparing the core fixed income returns, and I'm looking at 9.24% in the second column, with the non-core area, 14.25%, this indicates that that spreads widened as well. And what that means is that credit risk rose during this period. And why did it rise? It didn't rise simply because of inflation. It rose because the Fed suddenly, maybe late in the game, maybe at the 11th hour, that's debatable, got religion and started raising rates to the extent that there's a possibility that we will either have or are within a recession. And recessions tend to create credit risk, and credit risk is greater credit risk is reflected in greater credit spreads. And so you can see the non-core fixed decline in returns was greater than the core fixed return. That's perfectly normal. One of the interesting things, and I mentioned that even during the 70s, there were areas of the capital markets that did better. And that's true in this decline as well. Look at real assets. Just like in the 70s, energy did better. I think energy and some of the other real assets that are in the portfolio under Ethan's tutelage are performing definitely better than equities or plain vanilla bonds, or certainly long duration bonds. And you can see the big outperformance there. And that's one of the caveats that I would say is that And if you drop down to private equity, you can see that the difference column, the performance over the benchmark, those two are huge. And they essentially are huge drivers of the total fund's outperformance of its benchmark. But I would say that in the case of private investments, the topic of the day is whether or not some of the limited partnership valuations will be trimmed when the appraisal process, the evaluation process moves forward over the next 2 quarters. This happened during the GFC, but this was a big help during this period to smooth out earnings. And we don't expect all of this gain to go away in the revaluation downward, probably not even close, but to be determined. We also, if you remember back to our interminable and frequent conversations about private equity benchmarks, that we had always said that when the public equity markets are soaring, private equity is going to appear as if it is falling behind. And that's a bit of a mirage. It's not true. And so in this particular case, we said that when public markets fall, it's going to look like private equity is soaring. And as you can see here, it is vastly better if you compare the 21% decline in domestic equity with the almost 7% gain in private investments. That's a huge gap. But again, it's huge in the sense that timing will whittle it down and make it closer. If you look at our capital market assumptions, you'll see that we're typically looking at something in the order of 2.5 to 3.5% gap between private equity returns over the long run and public equity returns. So this kind of gap is almost certainly not sustainable. The bottom line is that when we look at your asset classes and we look at the total fund, it was a brutal 2-quarter decline, and July has definitely proved to be better, including today. And I think that the diversification that you've built into the portfolio has done very, very well in terms of preparing the portfolio as equity oriented as it has been historically for a downturn like this. Constituencies outside that maybe don't have the deep understanding of the dynamics of the capital markets may look at a period like this and say, things are going terribly. Things are going very poorly in the capital markets, and institutional investors operate in the capital markets. They can't turn chaff into wheat, but they can make sure that they survive until the rains bring new green shoots into play. And one of the interesting things about this is that it was mentioned earlier that yields are rising and cash is starting to actually have a positive return. The effect of rising interest rates in the fixed income market, we call it a self-healing effect, is that in the long run, the pain of the capital loss that you've experienced and other institutional investors has experienced in this period where interest rates have risen, inflation has harmed the bond market values, gets made up over time, in the sense that as the portfolio rolls over into new bonds at higher coupons, you will recoup some of those losses, hopefully all of them, and begin to show positive returns over a long period of time. Those were the key things that I wanted to mention, but I wanted to end with 2 comments that I don't have the answer to, that are I think a couple of the core issues of where we stand today, and whether or not these last 6 months are the end of the pain that portfolios will have to go through, or whether there'll be more. When we lowered our capital market assumptions at the end of last year, based on end of year data, we did not expect there to be such a big decline. We didn't know whether there would be regression toward the mean that would take place over a number of years. But it turned out that the Russian invasion of the Ukraine and the incredible spike in inflation and the Fed's reluctant but nonetheless necessary return to monetary tightening would make a portion of this regression to the mean that we anticipated in those capital market assumptions happen faster than normal, just the way the history played out. And we'll see where we stand. We're just 2 months away from starting the next process for looking at our forward assumptions and what this year's actions might mean for longer term expected returns. But the two issues that I wanted to leave with you to ponder, and maybe John and the staff have strong opinions about this, but the markets are still, if you look at them just with a cold eye and look at the numbers, appear to have some exuberance still built into them. And let me give you the two examples. One is that the last print on inflation that was mentioned earlier by the staff was 9.1%. And yet right now, the 10-year treasury is at 2.71%. That means that every time you lend money, you as an investor lend money to the federal government, and you can put 1% or 1.5% on that for spreads and talk about lending to private entities, you're losing money in real terms because inflation is vastly higher than the interest payment that you're getting in return. So, and not only are you losing money, but this gap is unusually large. So the market, one of the important things that that will matter to the performance of the portfolio going forward is how this gap gets addressed. It could get addressed by the Fed succeeding madly and quickly and thoroughly in quelling inflation so that it comes down to 2.5%. And so this huge gap between 2.71 and 9.1 gets washed away by successively defeating inflation. Or if the Fed is not successful and inflation comes down but still hangs in around 5 or 6 or 6.5%, the investors may react by pushing interest rates up in their search for real return to the loans that they make when they buy bonds. So this gap, it has to be resolved some way. And we're not sure how it's going to get resolved, but how it gets resolved will have a powerful effect on the performance of the portfolio. The second thing I wanted to point out was that the yield curve has inverted now, and it's not deeply inverted, but it is inverted now more across more portions of it than it has been in the brief inversions that we've seen since the GFC. So if you were to look, for example, at the 30-year bond at 2.95 at the close today, the 6-month treasury is almost exactly that at 2.93, so flat. But the 1 year is 3.08, so it's above the 30-year. The 2-year is at 3.08, it's above the 30-year. The 5-year is just below the 30-year at 2.83. So typically that has seen to be a signal that investors either expect a recession or a successful soft landing by the Fed in terms of defeating inflation. But inflation has to be defeated in order for this yield curve to make sense. And if it gets defeated by a recession, which yield curves typically are one of the best, if not the best predictors of, then it will also not likely have a positive effect on equities. So we still face challenges going forward, and these numbers and where the equity market are seem to us to indicate that that there's still unresolved issues between valuations in both the bond market and the equity market, and inflation, and where interest rates stand today. So I'll stop there and see if there are any questions that I can answer. I've gone on long enough.
Questions?
John's answers to the question.
Yeah.
Well, thanks for being so depressing.
You gotta do what you gotta do. I could dress it up a little bit.
Oh, no.
That's just how
Just-
Jack likes it.
Yeah, that's how I like it. So just to be contrary, is there any good news?
Yeah, no, I think so. I think so. If you look at the labor market, the labor market is tight. That's a problem, actually. But there's still a large number of folks not in the labor market that could be brought into the labor market. And if you go back again to the 70s and ask the question, why did inflation last so long? Why did it get so embedded? Why did Volcker have to raise short-term interest rates to double digits to defeat inflation? Here we have this Fed, they're not even deeply into single digits yet. So if we were to, and the reason is that I think that inflation was allowed to go deeply into the labor markets and where it is very hard to change. If we were to look at the same situation today, we at least have the prospect of having large numbers of people who apparently are just not interested in working, perhaps in a recession may come out of the woodwork and help us sort of keep inflation in check by adding supply to the labor market, and particularly keeping inflation from not being a 1 or 2 or 3 year situation, but maybe a 7 or 8 year one. So I don't mean to be so gloomy. I'm not gloomy. I'm just factual. So sorry about that, Jack. For you, I would be extra gloomy if you asked me to.
That's okay. Thank you, Jim.
Okay, anything else for Jim? Okay, then, John, you up?
I think.
Thanks, Jim.
Tab 6. Is that right?
6, staff investment update, yes. So starting on slide 4. As Jim just mentioned and highlighted, a little bit of a decline for the fiscal year here. First time we've had that in a while. I hate to say $1 billion is a modest decline, but kind of a modest decline, I guess, on a relative basis anyways.
Don't put that in the minutes.
But as always, I would point your attention out to the longer term numbers here, the 5-year and the 10-year number, still strong growth over the long term, still more than increasing the value of the portfolio over time, well in excess of our net cash need for the beneficiaries. And that, of course, is what we most care about. Moving to slide 5. Retirement plans here broken down by the asset classes. You can see that net cash flows for domestic equities, private investments, and core fixed income were the most negative over the last year. Generally, we needed to probably in the first half of the year, more likely to have been selling domestic equity to meet benefits, core fixed income more likely in the second half of that year for all the reasons that Jim has just mentioned. And private investments, as we've talked about in the last few quarters, we've had very strong realizations there over the last year or so. And so that was also a place where we generated some capital from.
Charlie missed it. Why again is international cash, why is that positive international?
So memory serves here, we did add some to international equity, probably back more so prior to kind of the Russian invasion.
Yeah.
They were already looking cheap, and particularly as we were having domestic equity running very, very strong, we were kind of rebalancing back in to bring that back to the midpoint typically. The other little piece I would point out here is that cash looks a little low relatively speaking to, most of the time. We didn't really draw it down that much. But at fiscal year end, we have, State Street closing the books, our accounting staff closing the books, and there's a couple of week window there where we really don't want to make transactions because it's very difficult. Accounting gets very unhappy with me if I try to rebalance in that time frame, as does State Street. And so we moved more cash than typical into private investments, real assets, real estate, in order to meet any capital calls that could come during that period. In addition, we typically get kind of a bigger cash infusion from teachers and volunteer firefighters in that July timeframe, as I think we kind of get that kind of double payment there, I guess, essentially from end of the year for teachers and similarly for firefighters, some injections there. So we knew we had cash coming as well. So really just a timing issue is what I'm trying to say there. If you move to slide 6, and I think hopefully all of you got the updated slide 6. It's just the table was a little messed up there, but it should show that obviously the biggest net cash outflows are in public employees and teachers being the largest plans, similar to what it is most time periods, obviously, in terms of the outflows.
Is the highway patrol positive because the legislature put some money in, or why is that positive?
So which one are you?
Which one?
I'm on net cash flows for highway patrol retirement.
I think you're looking at the old one.
Oh, is that
If
it?
you're looking at the old one, it would be firefighters.
Keep the other side of it. The other side's still good. It's just the back side.
We got a new one that shows it down, Highway Patrol 2.5.
Firefighters are slightly positive though. Okay, off the top of my head, I couldn't tell you exactly. Slide 7, overall performance. So noted slight negative here for the fiscal year. But still good long-term performance over all the longer timeframes here, meeting our actual actuarial hurdle over the long term. So that is important.
These are on fiscal year or calendar?
Those are on fiscal year. 1 year as of June 30th. Slide 8. Performance for the individual asset classes. Jim nailed it. Not much downside protection from holding bonds, which is pretty unusual, particularly to the degree to which that happened over the last 6 months for sure.
Can't we blame John?
We absolutely can blame John, and that's true of almost all things. Almost always works. I would note, as we think about kind of our long-term strategic asset allocation, if we think back over the last 3-4 years, we have moved core fixed income down in our asset allocation. And one of the big reasons for that was that rates were very close to zero. And it was, somewhat expected, I guess, if you will, that bonds were not going to protect you should the Fed start to raise rates. And we could actually be in an environment where we had both equities and bonds losing at the same time. And here we are. Slide 9, asset allocation. So you'll certainly see here that we are deviating more from the midpoints than we probably typically have. High level reason here is simply because most of the upside here, or the things that did well, were in the illiquid asset classes. It is not terribly easy to go sell private equity stuff or real estate or what have you. So much more difficult to rebalance. And kind of is what it is, I guess, if you will.
So looking forward to, not a big discussion of asset allocation, but is there any of this that surprises you or making you rethink some of that allocation stuff?
No, I wouldn't say it surprises me. And there are levers that we can pull to some degree to try to take a little bit off the table, particularly within real estate. For instance, we do have REITs. We've got some public CMBS oriented debt strategies there. And we have trimmed some of those. I would also say too, that these numbers are slightly elevated within private investments and real estate in particular, because as I mentioned, we have a little more cash here. Then, so once we sort of backed that out after fiscal year end, got all settled, that helped. Today, we're sitting a little south of 2% overweight to the midpoint, so it has come down somewhat, but I don't, I guess it's a discussion we're having currently, Jack, as we, towards our asset allocation discussion with RBK at the end of August, but I don't see huge changes here that need to be made because of anything that's going on in the portfolio at the moment. We'll have some stuff at the margins. Slide 10, so economic environment. I think everything Jim said was spot on. There's a lot of mixed messages out in the market right now. I thought I would show this slide on slide 10. This is a spreadsheet that we've had for quite a long time that is basically Bloomberg data. So the Bloomberg data automatically populates here. We can update it all the time. And then I like the little stuff out at the far right that basically shows the change in data over various timeframes. This is kind of a summary of the summary page, if you will, because it was about all I could fit onto this slide where you can actually still read it. But you'll see, there's some red here, there's some green here, and basically at a glance, if I'm looking at this, it says, well, there's kind of some mixed statistics here. Some things are pointing much more negatively for the economic environment, and some things are still looking reasonably positive. Absolutely right. Inflation is sort of the big story right now. I don't think that's a surprise to anybody. Inflation sitting at 9% plus for the headline number most recently, but even the underlying kind of what they call core inflation, which is probably what the Fed looks at more, somewhere in that 5 to 6 range. That's still extremely high relative to anything we've seen over the last couple decades at least. So certainly a huge concern here. The Fed's reacting to that. You see up at the top, the leading economic index starting to slide a little bit. So not a huge surprise, but just below that, job growth still extremely strong, 375,000 on average over the last 3 months. You can see it's starting to come down a bit from where it was, but those are huge numbers. Average hourly earnings extremely strong. I completely agree with Jim, and I got another couple slides here later to show, but payroll and employment is going to be a huge issue, and sort of how that shakes out is going to be very impactful to where we ultimately end up in the economic environment. So, I guess all in, big message, kind of a mixed bag. Maybe last thing I might throw in is just today, we got, if you look down at the green box, production, ISM manufacturing, and the services index. Those are two indices that tend to say whether we are growing in the manufacturing sector in the US and then the services sectors broadly. Anything that's above 50 indicates growth, and anything below 50 is contracting. So again, very strong numbers here, but today we got the services index and it was 56.7. So it actually ticked back up to a very strong level. That's sort of an indication, well, is the Fed raising rates having as much impact as they think right now? Because the services sector is the biggest piece of the US economy. And so that's still rolling along pretty good. And that's just 1 month's data, of course. We're going to look at the longer term trend, but probably not what the market wanted to hear in some ways, I suppose. Following page, economic environment, same thing I've gone over here a few times and Jim talked to quite well. The Federal Reserve obviously raising rates and shrinking their balance sheet, but these are blunt tools. And they're blunt tools that they're using to try to decrease demand at the end of the day. I mean, they aren't going to say it, but they're trying to cause a recession, or at least as close to a recession as they can get. Sure, they'd love a soft landing, but they want to make sure that inflation moves back down. And in order to do that, you've got, right now, supply and demand are out of balance. You've got not enough supply and you've got a lot of demand, and that's why prices are going higher. And their blunt tool is to try to reduce demand. That's pretty much all they can do. So that is why the market is so nervous about the potential for a recession. Slide 12, you can see here, this kind of speaks to more the supply side of it. Federal Reserve has just kind of a broad index that looks at supply chain pressure. It's starting to come back down, but it is certainly nowhere close to where it was sort of pre-COVID, I guess, if you will. So a ways to go there, but trending the right direction. Similarly, the commodity index, certainly driven a lot by oil, but also by metals and things, has certainly come back down, but again, pretty high relative to where we were a few years ago. 13, looking at 13, pressure on wages. I think, again, maybe this is where I get most concerned, but it's most uncertain. You would expect that we should be able to have more people return back to the labor market. The slide on the left here is labor force participation for people who are 55 years and older. And that's the red line. And then the green line is labor force participation for those that are 25 to 54. So you can see in the younger cohort, we have moved back up to a place where participation rates are getting close to where they were pre-COVID. Whereas in the 55 and older, that has not happened. My theory might be is that we've had a lot of people that have just said, I don't want to deal with Zoom calls or whatever, and I'm going to drop out of the labor force and retire early or what have you. It's certainly, you've got a big wave in the baby boom generation here moving through, but I'm not sure. I don't know that anybody really is, but that's concerning because, even though that they're not a huge slice of the overall population, it is, I want to say, I think 15%-ish of the population. So on the margins, that's pretty meaningful to whether or not we have tight labor supply at the end of the day. There's enough people out there to take all the jobs. Slide on the right, kind of similarly, obviously a lot of this is driven by COVID, but you can see that immigration went down dramatically. And that includes, things like work visas and stuff. So again, maybe that may rebound, but how long does it take for that to rebound? And the longer it does, that can have an impact as well on just a longer term tight labor supply, which can help push up wages. And once that gets ingrained, it's going to be harder for the Fed to reduce inflation. And finally, maybe the last piece I would put on there, no slide on this, but we clearly have at least talk. It's hard to determine how much is real, but more talk of onshoring. So to the extent that we are deglobalizing and trying to bring factories back to the US, well, we need labor in order to run those factories. And where is that coming from if we already have tight labor supply? It has to come from somewhere or else wages are going to go up and up and up. So some concerning things there in terms of the Fed's ability to be able to truly handle inflation. And finally, for economic environment, slide 14. So this is the volatility index, the VIX as we call it. So it just measures the volatility of the S&P 500. A lot of market participants look at this in broad terms. If the VIX is below 20, tends to indicate that it's a pretty stable environment out there. If it's above 30, it's generally, there's a lot of uncertainty and fear. And you can see that ever since the pandemic, it came down, in 2021, but it still remained quite a lot higher than it did pre-pandemic. And that just speaks to the extreme volatility we've seen in the market. And then if you look kind of closely at 2022, boy, there's a lot of peaks there that are above 30, a lot more often than we've had in the past. And I think that could quite likely continue. So, sorry, Jack, not particularly rich.
That's fine.
Okay.
Nothing but the truth,
That's right. And finally, for my update, slide 15, investment challenges continue. I think this is basically the same as what I had last quarter. Hasn't changed a whole lot. I don't know that we have, much greater visibility than we did before, but keep watching and hanging in there. We talked about ISS as our proxy provider, something we've been working on for sure. Contract updates for the external public market managers. Part of that, as I mentioned, is moving them to the new proxy process, but also separate account stuff that we talked about a little bit as well. And a few other managers, as we've talked about in the past, we're continuing. I think we've got a couple left that we're moving to, I guess, what we would call the new contract, if you will. They had a very old contract, so just updating that with them to make sure that everybody's relatively on the same page. Sec lending, we're looking at a separate account there. It's kind of just stems from our recent custodial contracts, something we felt like we needed to sort of take a look at. So currently, when we do sec lending, if somebody provides cash collateral for the securities that we're lending, State Street invests that for us in a government and agency account. So a very safe account, not a lot of return or yield there at this point in time. We're thinking about possibly doing a separate account there with them because we will be able to control what they're able to invest in and control the parameters there, unlike some of their other portfolios where, again, it would be like a commingled account and we'd be in with other participants. Some of you will remember us being in those accounts essentially when we hit the GFC and we had some issues there. So we don't want to do that again. But we would consider a separate account where we had control and we control what the parameters are. So something we're exploring. I don't know if we'll end up doing it or not, but just FYI that. Solovis Risk Systems process continues. At this point, they have loaded all the data that was to be done basically as of July 1st. We've had some hiccups with that though. When they loaded all the data, there's some duplication and some other issues. So they're going through and cleaning that up. So they're a little bit behind schedule, but that's supposed to be all cleaned up within the next 2 weeks or so. So it continues apace there. More to come.
So are we doing some of this data cleanup or?
It's mostly on them. We're certainly helping with that. Aaron and his team in particular are involved, just making sure that things match up the way that we wanted to, categorizing some of that stuff, making sure that we can work with the data in the way that we want to, things like that. Ongoing due diligence, continues, of course, in all the illiquid asset classes as we have continual fund rollover there. Jason and I just went to, did a due diligence on site with a convertible manager that hopefully will have convertible bonds, which we've been talking about for a long time, but hopefully we'll come back with something more concrete in the next meeting or two. So far, so ongoing discussions there. Getting closer, hopefully, to the finish line with that one. And then finally, well, we talked a little bit kind of at lunch, continuing to work with new and existing clients. We've got meeting the state fund in a couple of weeks, some other separate accounts, potentially with state government agencies. I think that's all I have for the moment. Any questions for me before I turn it over to Aaron?
If you look at convertible, is that for all of the accounts, the public, the pension funds and?
It is if it's appropriate for them. Yes. So it wouldn't be something that we talked about. I think it could be a fit potentially for state fund. It wouldn't be something we would do in trust fund because there's an equity component there and you can end up with equity. They're not allowed to hold equity, so not a fit for trust fund.
Aaron, good afternoon. One thing on the Solovis, I guess what I'd add is it is taking them a little extra time to clean up the data to where we need it to use it. But at the same time, it's allowing us some time to really understand the Solovis as a tool. It's a very powerful system and it can do a lot. And it's fairly complicated. So we spent a lot of time doing some classes and holding trainings with their team. So we're getting there. So when it is fully operational, we'll be able to use it to hopefully its full ability.
Doesn't mean when you say complicated. Because if it's complicated, users won't use it.
Yeah, and that's why there is a lot of trainings we have with them. You know, we have our triannual with them. They come out here 3 times a year. In 2 weeks, they're coming out and we'll hold some additional trainings with their team. So after, going through the trainings that are standard through the tool on their website, we just have a list of questions we're going to go through with them. So yes, it's complicated in some areas, but I think with everybody here, doing what they can to learn, it's going to be used pretty well.
I'd add something to that, Mark, that I think there'll be different levels of users too. So I think Aaron and his team will be the people that really understand it down in the weeds and can, manipulate reports. Whereas others might just go to the canned reports that we can set up for them and they can run what they need. That's a little simpler, if you will. So there will be certainly varying levels of users for it.
And we have access to the full Solovis team too. So we've done this plenty of times so far where we ask them a question, if we can't figure it out, and they'll hold a meeting with us virtually or get us what we need. So it's we can always rely on them for that. So I'm on the macro attribution key takeaway page, starting with strategic asset allocation. As we all know, most asset classes did not do real well this year, with the exception of real estate, which was a strong positive contributor. But overall, the pension policy mutual return was about 10.5%. On to tactical, we were slightly on average overweight real estate and core fixed income for kind of that reason. Most lost, real estate was a little bit above and core was because it didn't lose as much. In the last quarter, we were underweight domestic equity, but we're still periodically rebalancing, and over the entire year, our underweighting, overweighting of the asset classes increased the pension portfolio return by about 15 basis points, which is a small amount. That's the way we want to keep it. We really don't deviate from the midpoints very much. File selection, there wasn't a lot of effects this period, which was somewhat surprising. The exception was real estate. We have 2 managers, one with exposure to a REIT benchmark and one with exposure to a commercial mortgage-backed security benchmark. So those are public benchmarks being compared against the NCREIF ODCE, which is a private benchmark. That's going to account for, I guess, the majority of what I would think of the difference there. It should catch back up and, at some point maybe go the other way. So that's just kind of the nature of the public-private benchmarks. Within manager selection, I'm going to touch a lot on the public managers. For one, we don't have the domestic publics anymore. Our internal portfolio within core fixed income was a good positive contributor this go around with 17 basis points outperformance at the total pension level. And to get to the kind of the glaring one here, private investments, it's really the reason that our return was what it was, why it wasn't much worse this year. But have to add with the caveat, this is because it is the investments are lagged in pricing. So at some point that will catch up. But that being said, it was a very strong performing portfolio in its own right. So again, another example of the public and private making difference. I guess I'd also just touch on in real estate, our LPs, the REIT manager and our CMBS manager all performed very well, which added to the already well-performing asset class. and add an additional 54 basis points. Any questions on the data?
Question?
All right,
We're gonna do private
I'm gonna do private investments. Michael, or I mean, Thomas sends his apologies. He is on vacation. So,
This is not a negotiation tactic or anything.
no, it was not. He was trying to make it to a place where he had a good connection and all that good stuff, but he wasn't gonna quite get there, so I'll run it, I guess. So private investments, environment overall, we've certainly seen, consistent with the broader market, slowdown in private equity deal flow across the board. Big drop there, big increase in the value that's been traded. No particular surprise there, given the last 6 months, I wouldn't expect. Still, though, intense competition for deals. When deals are getting done, still valuations are somewhat elevated to that longer term average, although come down a little bit from probably where they were prior. Leverage, again, similarly, a little bit elevated, but not too far away from kind of that 10-year average. Fundraising, still strong. I don't think we've seen any real sea change here or anything. When you look at others' asset allocations, there still seems to be that strong push towards continuing to move up the private allocation across the board. So we have not noticed that there are a lot of funds that are coming to market and not being able to hit their hurdle. Maybe the one exception there, I might say, is venture capital. Certainly seems to have probably hit a wall, certainly in kind of that, maybe what I would call second tier, I guess, if you will, venture capital firms that, those top 10 or 20 firms in the venture capital space, still not going to have any problem raising a fund. But if you're not kind of in that tier, that's probably gotten a little bit more challenging for them and maybe a bit of a pullback in that space. While we've seen some slowing here and a little bit of change, I'm not sure it's real clear that there's any big takeaway here that the environment's going to really shift, and that power is going to shift back to the LPs, as it were, when we're signing up for deals and things, that we're going to have some significant amount of power, be able to be much choosier about things and all of that good stuff. So sort of things continue apace, and we'll see what happens, in the next couple of quarters as we start to see new marks come in and things like that for the existing portfolios out there. Slide 20, as we've already talked about several times, very strong performance relative to the benchmark, but again, would point you towards the longer term numbers, and particularly the relative return to the benchmark, the 10 and the since inception returns, a couple 100 to 300 basis points over the benchmark. I think that's what we would expect for this portfolio, and so that's encouraging. It's doing what we would expect it to do. Slide 21, total market value of the portfolio, 2.3 billion as of 6/30. Still North American centric, in the non-US developed, and 14% in emerging markets. Don't really see any huge change there to kind of that geographic type weighting as we go through time. Of course, it's not something that we specifically control for. Some managers have latitude and things, but it will probably remain somewhere in that ballpark. Direct primary fund exposure. Of course, for a long time, we've preferred to have direct exposure wherever we can, rather than having fund of funds. And we're probably still going to have a few fund to fund relationships in those areas where we can't access things as easily, things like venture, things like that. Same as it's ever been, I guess, continue to focus a lot on the existing private investment relationships. So you'll always see, we have a new one come up here and there, but certainly continues a lot of re-ups, and that seems to be what the schedule looks like for 2023 as we look out at this point too. Would expect, heavy re-up schedule. Cash flow profile, we saw a little slowdown here in the most recent quarter, so actually a slight negative number that's been strongly positive in the last few quarters prior to that. But again, not particularly unexpected as the environment has shifted, and a lot of what we were seeing was realizations from both private equity and VC firms as well that were having very strong realizations over the prior quarters and took advantage of the environment that we were in. And then Ian, of course, already talked about the tree line commitment.
So, just one quick question. Sure. I don't think we're in the market to sell any, but how is the market to sell private investments? And in this last few months?
In the last few months, it's certainly come off significantly from what it was. So it was secondary market was very strong prior. I can't say that I track it, really closely, but just kind of some of the industry info looking at that, certainly the spreads for doing that have widened out.
So I guess my real question is, it's always that it's not a liquid asset, but in some ways, at least in my mind, it can be. Is that true or not?
So liquid, I think, would be too strong a term. You can certainly go out with secondaries. Sure, you can certainly sell into the secondary market, and you could do that today. I guess I equated a little bit to the public side of the market where domestic equities are liquid, and I could sell them tomorrow. But do I want to sell them at that price if the market's going down? I guess the other thing you have to really think about on the private side is that's a very long runway typically. So you can't just call somebody up and today say, well, I want to do a secondary sale. It's probably going to be, 6 months before you actually get all of that done. The market might have changed quite a bit. Part of the reason we've talked about it periodically, and we did it a couple of times. I guess my bias has been typically, well, we're a pension plan, we have an infinite time frame, and in order to sell on the secondary market, you have to take some type of haircut typically, whether that's a 10% or a 20% haircut, depending on the time frame that you're in. And I guess I tend to think, well, why do I want to take that haircut when I have all the time in the world? Unless there's some other compelling reason why I need liquidity today in order to fund some other part of the portfolio. That's been the case for us. So,
Yeah, I would just chime in if I could that a secondary offering, there are a limited number of secondary buyers, secondary funds out there. It's grown over time. But as John said, you need to put together, you can't sell individual LP relationships very easily. What you have to do is you have to put together a bundle, and that takes time. You have to deal with a broker, typically a strategic advisor that will say, oh, the secondary funds are looking for a package that looks like this. And this will bring a haircut of 5%, whereas if you create a package that looks like this, it will be 15 or 20%. And as John said, it takes a long period of time. So you invest a lot of effort to tee up something that where the market conditions when you actually are ready to execute might not be anywhere close to what they were when you thought that you wanted to do it. So I'll stop there.
I guess maybe final note I would say, Jack, is I guess in my opinion, at least thus far, given our limited resources, I think our time is better spent elsewhere typically.
And is the bundle that Jim was talking about, is that just the nature of the market, or is there a reason why it is that?
It's just the nature of the market. I mean, that they've got to go out and find the buyers essentially for you. It's like talking to a broker for the bond market or something. Except you got to put together the pack, they're going to look at your portfolio and say, oh, I've got people who are interested in, these funds that you're in. They're going to try to pull, you probably want to sell all the funds that you think are bad funds. They want to buy all the funds that they know are good funds. So, it's a negotiation.
So really what you want to do is take all of the prime stuff with the subprime stuff, bundle them together and sell them. Things can't go wrong.
Nothing can go wrong.
Then get a rating on them too.
Yeah, we get a double A rating, can we?
No, absolutely, for the right price.
Anything else on private investments? Anybody else? Ethan, it's nice to see you again.
Thank you. It's nice to see you too. Thanks for having me back.
We wouldn't miss it on.
First and foremost, it's a hard hurdle. All right, any other questions there? Okay. All right, so look, I'm on page 22, going over real estate. Big picture, there's a lot going on in real estate. A lot of mixed signals, things are changing. Operating fundamentals on the ground seem to be still pretty healthy. As of, a couple weeks ago, things have started to decelerate a little bit, but, occupancies are holding strong. Rents are still growing in many respects, but maybe not as strongly as they were 18 months ago, 12 months ago, even 6 months ago. Basically what happened was the Fed raised rates 75 bips, a month ago, and that almost put a full pause on the capital markets for a while. My phone started ringing and GPs were calling me and saying, hey, we're pencils down. There was basically a giant pause, and that pause is still sort of in effect. The Fed raised rates again, this week or last week, this week. Rates are going up, cap rates are going up, transactions are slowing, but still happening. Prices are adjusting anywhere from 5 to 15%, depending on the market, the property type. Delinquencies in the CMBS market ticked up for the first time in months. Rates have traded down almost the entirety of this year, but maybe not as much as the broader market. Fundraising has slowed relative to years past. There's still a ton of dry powder out there. I think real estate is still a favored asset class for many reasons. It still at this point has a higher current yield than bonds for the moment. It's still viewed largely as an inflation hedge in some respects. There's still a crush of capital looking at real estate. I think people are going to start rethinking about real estate relative to inflation and might be adjusting their allocations accordingly in the near term. That has yet to manifest anecdotally and stuff I've read, but reading the tea leaves that might be in the works. So there's just a lot in flux. And I guess the main takeaway I would say is, guess what? The cycle has finally turned. It's beginning to turn. Real estate is a cyclical asset class, and we've been in this upswing since March of 2009 when we started clawing our way out of the GFC. And frankly, this has been the largest or the longest real estate sort of upswing that we've seen. Things are turning a little bit, and how deeply it turns is anyone's guess. It's not turning because of real estate, in my opinion. It's not a supply and demand issue. It's not a leverage in the system issue. It's a broader economic inflation, interest rate driven repricing issue. And I'm not overly concerned, but things are just sort of decelerating, but not dropping off a cliff. That's kind of the main headline. Happy to address any of these bullet points or any other questions. I'm always happy to chat and, have a conversation.
Are we prepared for that?
Look, I think we are prepared for any downturn, given the nature of the overall structure within which this pension fund operates. My personal view is we should be relatively blind or agnostic to volatility. Cognizant of it, certainly, but when things go down, we should buy more because we invest perpetually. And so short-term fluctuations in a investment framework that theoretically exists in perpetuity should be taking advantage of those dips and that volatility and buying more. So I think real estate is well situated. It's a hard asset that has good downside protection. We have a conservatively levered portfolio. We're in asset classes that are, we are overweight to property types that are less correlated to the overall business cycle and consumer behavior. Hardly any hotels, actively diversifying away from office, heavily weight, housing, heavily weight industrial. I think we're as well positioned as we could be. We've got, debt in the portfolio, a reasonable position there. Senior position in the capital stack above the equity. We've been selling REITs and harvesting gains. I have a different view of REITs, a lot of volatility there, but they outperform sort of core real estate longer term. So I think a permanent position is good there, but we've been, getting liquidity when we need it and harvesting gains. And we'll be well positioned to add when the time comes. I think our portfolio is in good shape. We're not chasing super hot sectors. I mean, you could argue that multifamily and industrial are hot, but we've always been in there. That's been sort of a long-term strategic view, and will continue to be. I mean, we're short housing as a nation. Interest rates are going up. People can't afford homes anymore, so they're going to go to the cheaper option. There's all sorts of crazy trends going on in industrial with e-commerce and onshoring, retailers building up inventory, and just continue to scramble for space just to have inventory or just meet demand. So sorry, I'm rambling. I'll stop. We're well positioned as we can be, and we've made some recent commitments and we're going to be, we've got dry powder. We're buying on the dip for sure. And you can't time the market. So you just keep investing. That's what we do in a pension fund. I mean, that is our charge. We take risk, we allocate capital. Always. We can't be out of the market. So I'll stop.
Yeah.
All right, any more questions? We'll flip to page 23. This is performance. It's been very strong. It was very strong last quarter. It continues to be strong. Real estate, I think, this is reflective of REIT's sort of recent performance, real estate's general cap rate compression over the last, particularly, through COVID and up to today. But I wouldn't expect to see these numbers persist. They'll definitely, setting expectations, I would see smaller numbers next quarter.
This is what we set your benchmark here.
Okay, well, you can set my benchmark there, but I'm setting the board's expectations. Questions about performance? Right, very good. Turning to
Yours or the
page 24, a lot of the same. I'll direct your attention to maybe the fourth bullet point, which you've seen for a while. I'm happy to say we finally signed on the dotted line our first separate account as of yesterday. So we will, in relatively short order, begin to deploy capital there. Specifically, and I'll bring a board brief to next quarter's meeting, but this separate account is focused on infill port-oriented industrial, where there's essentially, I think, Inland Empire, Los Angeles, where vacancy rate is like less than 1%. And there's essentially zero land to build on, and any land that is available has recently been subjected to, development moratoriums. So think super high demand and constrained supply in these infill port-oriented markets that have had and likely will continue to support higher rent growth rates than your standard sort of big box out in the middle of the prairie in Tulsa, Oklahoma, where Amazon has a big distribution center, but nevertheless, a pretty specific strategy. So very excited about that. Partnered with a manager who has been doing this for a number of years and has a very attractive track record, very low loss ratio. And so we can talk more about that in November or maybe October. Otherwise, sort of reducing core, continue to focus on, our high conviction managers, very North American centric and broadly diversified. Happy to address any specifics. Always happy to have a conversation about anything on this page or otherwise, real estate related or otherwise. Ethan, please.
What does a separate account look like for real estate? What do you actually see in the account? I mean, obviously I know what that is for stocks. You see the stock. in the
Sure.
account. What does it mean for real estate owners?
So it basically means that we have partnered with a real estate general partner, not dissimilar from a commingled fund, except we are the only LP or investor in that fund. So what we will see is just individual properties that we've invested in. That's it. And we will be the majority owner of that. In this case, we have a 90-10 relationship where we're 90% of the capital, they're 10% of the capital. So the cool thing about separate accounts, one of the cool things about separate accounts, in my opinion, is whereas in a commingled closed-end fund like Marcus Partners, for example, the general, we're in there with probably 20-ish other LPs. The general partner puts up 2 to 3% of the fund. In these separate accounts, we can typically get way more capital alignment and get them to invest, 5, 10, 15, 20% on top of our capital. So there's more alignment of interest there. And we get more governance rights because we're basically driving terms. We're 90% or, 80 to 90% of the capital. So we can really negotiate hard on the operating agreements and get more governance and control. We can get specific about strategy or, filling holes in the portfolio to the extent we think we need one. We can go seek out separate account managers to fill those gaps specifically if we want to, but really it's more about lower fees, more alignment, more control.
Does it require larger commitments?
Not typically, but generally, yes, if that makes sense. A lot of GPs will do separate accounts, but they, the price of admission is typically like $250 million minimum. It's just not worth their headache, I guess, is how they view it. But, we've built up these folks that, it's a relationship business, Dan, as a lot of things are. And, I think if they find people that are like-minded and, you guys sort of view the world the same way, they're happy to have the conversation. And a lot of times if you find a good partner, they're not chasing assets under management. They just want to be aligned with somebody who shares a common goal and can cough up, EverWest, these folks we just signed up with, they said they'd do an account for as little as 50 million bucks, but we want to get scale and we want to generate returns and, we want to put capital to work. So, and we have the ability to do that. We can't do 250 or 500 or even $1 billion in some cases, but, another account I'm working on right now is with a group that has said no to major investors a number of times because they're just not like-minded. And they don't share the same sorts of a lot of these folks can be hot money, even in an illiquid asset class. They'll call them, they're just in and out or, my pitch to these folks is, hey, look, we are long-term holders. And the reason why, which I've shared with the board before, but maybe before you got here, is these separate accounts, we've structured them to be very long-term, 20 plus years in some situations. Because the theory is, and I think it's not so much a theory as it is really gospel, is, if you go through the trouble of finding good real estate and good locations with good credit, good tenants, with good leverage at a good cost basis, that's kicking off good solid cash flow that in many respects ultimately is right below, right at, or even well in excess of our actuarial rate of return, why would we ever trade that away? Why would we go through the frictional cost of selling that? You know, because you got to pay brokers' fees. And then, you know, you have to take on the reinvestment risk of trying to recreate that portfolio all over again just to crystallize or promote and pay the GP. And we get our money back and then we have to reinvest it. Well, why not just stay reinvested in great real estate that's kicking off, you know, 6, 7, 8, 9, 12% cash, current cash, and hold that forever? Notwithstanding a major shift in the market or what have you. And so, you know, I'm off script a lot here. I realize that, but the LP GP finite closed-end fund model is broken. And it doesn't favor the LP. It is largely in favor of the GP, particularly in real estate, which, you know, people will argue is a naturally tradable asset and lends itself to buying and selling. But for someone like us who technically doesn't have to sell, we shouldn't be selling. We should be paying these guys to be aligned with us to create these bulletproof portfolios that creates immense amounts of cash flow and hold it forever. Manage it, actively manage it forever on our behalf to meet our benefits, you know? So that's what we're thinking about. That's what I'm thinking about anyway.
Do you end up with a higher concentration in individual properties?
You can,
And isn't that
That's-
riskier?
you know, arguably, Carl, arguably, but I would argue when you're with a really well-schooled and well-heeled manager who's been through the cycles and is aligned with you and has been doing this for decades. I mean, these portfolios are still going to have 10 to 20 assets in them and in strong markets. And yeah, while they may be more concentrated from a number of property perspective, that's true.
Are you concentrated in type of real estate or concentrated in locations, or what do you?
Concentrated in properties.
Fewer number of investments.
Fewer number of
Yeah,
investments.
right,
I
I
mean, I
mean-
thought one of the advantage of a bigger fund is that when they hit a clunker,
Yeah,
you're,
Yep.
it's not a,
yeah.
it's not a huge part of the,
There's logic in that, and there's portfolio diversification is absolutely not a theory, in my opinion. It is sound, it's tried, it's true, it makes a lot of sense. I guess that's why we do due diligence on the front end, and we make sure people have performed and have low loss ratios through cycles. And I would make a counter argument that a lot of people, in my opinion, in the private markets, over diversify and build themselves into an index and settle for mediocrity. And I would argue that we are in private investments to build conviction, make concentrated bets, and outperform. And you guys have put your trust in our diligence process to do that. And I take that to heart, and I sift through a lot of stuff to find what I think are really high conviction bets. And at the end of the day, one of my final decisions is my money's going into this too. And so that ultimately helps, in addition to the hours and weeks and months I spend traveling and reading documents and doing property tours and meeting people face to face and looking them in the eye. I put a lot of faith in that. But it is precisely that at the end of the day. It's faith-based, it's trust, but it's trust based on a lot of hard evidence, quantitative and qualitative research that we've done to build a story of conviction. Because we're in the investment game. I mean, there are no guarantees here. But you're right. If we're in a 6-property fund, which we're not, and we probably won't ever be, and one goes to zero, that's going to have an impact on the portfolio. Versus one that goes to zero in a fund that has 150 investments in it,
Right.
which will have some of those funds as well. And so if you put that theoretical 6-property fund into a bigger portfolio, you're still getting that portfolio diversification at the end of the day. So I think I just came really full circle.
I don't actually know where you went.
Diversification.
I.
That's okay, Carl was
The
listening.
problem is that
I think Dan was too.
I understood him, so am I really messed up here?
No, look, I'm very passionate about this and I take it very
Yeah,
seriously.
no, I
and,
understand, but it just, you
But your
you talked
point is
about
well
a
taken.
single,
On a standalone basis, I
Right.
wouldn't be doing one separate account that's only gonna have 6 deals in it.
And we're gonna, you gotta remember too, that, I mean, so we're talking about at least at this point, we'll have what, like 3 separate accounts? If that's, maybe $300 million. What do we got in real estate in totals?
1.7 billion.
So we still have a whole bunch of, we're still gonna have these other funds where we're an LP with a bunch of other LPs. This is one piece of it, but I mean, we're still gonna be very broadly diversified at the end of the day.
So, and it seems like it's a diversification in strategy or in type.
For sure, it's,
Yeah.
yeah.
We think the economics are better. Where we can make it work
With a separate account,
with a separate
but
account,
limited number.
long term.
Yeah.
Yeah, I mean, we can't do separate accounts in the entire thing. It's not gonna be possible. And, that doesn't work in some of the strategies, but it does in others, so.
Do you, is
Still
it
diversified.
are you shooting for a percentage? I mean, do you want
I don't think we've-
20%?
I don't think we've laid out a specific percentage or
Okay.
anything. I mean, it would just be specific opportunities that come to us.
Okay, but but you have to balance it out. I mean, this reward with that, I mean,
Sure.
you ought to be setting some idea of how much you want to put into these kind of things, I would think. What percentage of this portfolio?
I think we have an idea. I mean, well, let me put it this way. I think this applies best in kind of the core plus space where he's talking about, we have something where we long-term hold. Why would we trade that away? When we start to get into value add or opportunistic type strategies, that totally doesn't lend itself to, separate account type strategy. On top of, as he said, we'll have a REIT strategy, we'll have some debt strategies. So there's a whole bunch of other things around this, and Core Plus is, a big chunk of the portfolio, but I doubt that, all of it from separate accounts or anything like that. Partly because you may not be able to find the types of managers that you would want.
But the other thing to keep in mind, I think this 1.7 is just cap, right?
Yeah.
So one of my complaints about our reporting that we'll be visiting is real estate is going to be across trust fund and a whole bunch of other clients.
That's why this 80 million is 80 million instead of 130, which really caught me off guard.
Right, so
But what happened to the other 50?
that's on my to-do list for reporting future of real estate's not just a cap asset. It'll be, so that 1.7 is understated. And we'll have other larger numbers across.
That makes sense.
Okay,
Wait a second.
I'm not sure where you
I
were.
have a question. Oh,
Oh.
are you still working on this? Because I've got a
No,
question.
I'm happy to.
I've got a question on your
continue.
total leverage. It's 42.5. Are these 3 numbers down below supposed to be of it? 100%?
No.
I'm so confused. I couldn't read this.
No,
what the hell
those
does
will
this
not
mean?
add up to 100% for a very specific reason, because all the percentages allocated to each one of those are different, but the overall portfolio, when you factor everything in and the percentage of each part of our real estate allocation that's in each one of these strategies adds up to 42.5%.
That makes more sense. I thought, what the heck am I doing wrong? Okay,
Nothing,
Thank you.
nothing.
Well, there's all kinds of stuff she's doing wrong, but we don't need
Hey,
to.
Stop.
I'm not gonna touch that one. I'm just here to
Thank
report
you.
on real estate. Real assets. Any other questions on real estate? Okay, we'll move to page 25, real assets. So a lot going on in the oil patch, tight supply, demand uncertainties, China lockdowns, Russia sanctions. You know, US production is up marginally, I'd say. Rig count is up. MLPs have been a good place to be. That's been a large driver of performance within the portfolio this year. Oil has been a very strong performer. There's been quite a bit of volatility in lumber. Prices are still elevated, but not at historic all-time highs. Construction spending's, slowing down. Housing starts slowing down. That said, fundraising has been up dramatically in the real asset space for perhaps obvious reasons and, associated sort of inflation hedge. But yeah, it's all here for you to read. Happy to answer any specific questions or, like I said, have a conversation on any point.
So this timber, lumber elevation is gonna keep going up and up because of all these fires, right?
Yeah, there's some supply and
scary.
demand there
It's
for
scary.
sure. I mean, it's interesting. Yeah, perhaps, but we'll see with housing and construction coming off. That could be a counterbalance to, demand on the demand side. But, I think, I don't know the answer to your question, Maggie, but, I think in the grand scheme of things, even with fires, it barely dents the overall supply. And, it depends on, if those fires, excuse me, are in, managed tree farms versus the national forest and where the supply is actually coming from. So, we'll see.
I just know when my kids were looking at building a house, it was, when they started, it was 500,000, and now it's 825 for the same floor plan. It's like,
Whoa.
what the heck?
Yeah, I mean, a lot of that's definitely lumber. I think the last time I looked, it was like $650 a board foot versus 1,400, which we saw in April, I think it was the all-time high. But a lot of that's labor too, and cements. I mean, it's steel to the extent steel is incorporated. It's not a good time to be buying cars or building homes or anything for that matter. Other questions or? Seeing none, we'll
Anything else?
flip to page 26, which is performance. Happy to address any specific questions. We've been going gangbusters here. I don't expect this to persist. Setting expectations, Dan noted. Any questions? Otherwise, we can skip to page 27. We're within leverage constraints. You can see the portfolio broken out here. Again, it's pretty North American centric with growing international exposure. We'll be looking to establish a separate account here that's specifically focused on digital infrastructure. So think data centers, cell phone towers, fiber optic networks. So that's in the works and close to the finish line. Growing our existing relationships and focused on our high conviction managers.
When you say here, exploring other types of strategies to further diversify, can you go into that a little bit?
Yeah, so this is kind of an existing, perennial bullet point. The portfolio feels pretty good, but an example would be containers, intermodal stuff, chassis, other real assets that people rent that are critical to moving goods, services around the world. Data centers is one. We just committed to the rail fund earlier this year. Ag is something that's always there, Mark, but frankly, not been a focus. Debt, infrastructure debt could pop its head up at some point. Examples.
No crypto though.
I'm always
Not a real
looking,
asset.
I've said that.
Fair point.
These asset classes are pretty, I mean, there's a lot of stuff going on and there's a lot of managers doing a lot of the same stuff and it just, but they all say they're different, but they're not. So I'm always looking for something different and if it's worthwhile, but just because it's not in our portfolio, to me, isn't a good enough argument to pursue it and put it in the portfolio. Just because it's a fit, because it's not there, doesn't mean it's a fit. And so, you know, you don't want to overly complicate your life and it's got to be differentiated enough and compelling enough to make a good argument. But, you know, first and foremost, is it a good portfolio fit? So I'm always looking for new stuff. And it's not always that easy to find. And you know, that's okay. Because we don't have to find it. Because we've got a really good portfolio, in my opinion. I think we've got a really nice portfolio with some really good partners.
Well, you're meeting your 13.9 benchmark.
Dan would say it's 15 and I'm not meeting it, but I appreciate that, Carl. Thank you. Any
All
other
right.
questions?
Anything else?
All right, thank you all. Appreciate
All right.
it. Good to see everybody.
Nice to see you.
Gals.
Are you meeting your 13.9 benchmark?
Negative.
No.
Yeah, so that's the end of the green numbers. Thanks for having me. Could I refer the board to slide 28? I think that Jim and John covered the environment pretty exhaustively, so I won't go into that too much other than to say, yes, the story was all about inflation and what the Fed reaction was going to be to that. And Fed moved the front end at least up dramatically, a little less successful on the long end. Some other things that are interesting, 90-day corporate commercial paper yields were about 2.25% at the end of the quarter. So that's up from a couple of dozen basis points last year. So dramatic increase there. And we'll see those distributions from the STIP portfolio increase dramatically as well. Corporate bond spreads saw pretty significant volatility during the year, finishing up 75 basis points. Mortgages spreads were surprisingly constrained given the uncertainty in interest rates throughout the year. So keep thinking that we're going to have an ability to increase our allocation to mortgage backs, but still having difficulty finding that opportunity. The Barclays Agg returned to negative, a little worse than 10.25 for the year. Obviously higher interest rates and then secondarily increased spread premiums caused that. We did have a fairly strong liquidity in the bond market. So while we continue to see it decline, you know, never felt like there was a panic going on. Looking at performance, negative total return for the core fixed income of about 9.25% for the year, 105 basis points better than the index. The internal portfolio outperformed the index by 113 basis points, while Reams, who is our other core manager, outperformed by 51 basis points. So kind of felt like we took a few less blows to the head than the rest of the market.
Quite a few less, as Jim said.
Well, right.
Quite a few less.
Right, but still a lot of blows to the head. Reams outperformed on short duration, partially offset by an overweight to credit. The internal portfolio outperformed on the same duration bet, directionally the same duration bet. But we were also underweight corporate. So as those spreads widened, we benefited, whereas Reams was the opposite.
So we've had Reams a long time, and mostly up markets, but is this expected from you? I mean, is there performance and what you would expect in this type of market?
Yes, my expectation for Reams is they outperform in volatile markets. They're aggressive, reactive managers. They take big bets. And what we've seen is generally sometimes excellent outperformance in volatile markets. Conversely, they have a tendency to take bets in calm markets that just bleeds away yield over time. So they give it back in the calm markets, some of it back. I think I would say we're comfortable with that.
So they're a good sounding board. What's out then? See what they're doing. We won't be as nearly aggressive as what they would be, but certainly. And they're more plus. So they've got some aggressive areas of the market that they can play in as well. We just wouldn't in the internal portfolio. So it is helpful to talk to them each quarter. And we don't have on a relative basis, we don't have a huge amount of money with them. Our internal portfolio purposely.
And then anecdotally, I would just mention that the public markets team actually oversees the Reams relationship. But the fixed income team is always on the conference calls and involved.
Always blame somebody else.
Right? That's a hallmark of the fixed income team. Find somebody to blame first. About 1.8 billion market value at the end of the quarter. The duration was getting close to the benchmark at the end of the quarter at 97% of the index. We were overweight treasuries and agencies and underweight spread product, namely corporate securities. All I had for the core fixed.
Question? Okay.
Jason's online, I think, for us for the next piece.
Can you hear me okay?
We can.
Great, because I don't have any other alternative. The run through last night was great, so hopefully it holds up again today too. But before I start into non-core fixed income, on the topic of Reams, a lot of times we've talked about, it's valuable because they've had excellent performance over time, a good sounding board, a good information flow for the fixed income team, but I think it's also valuable to the public markets team. Our team covers non-core fixed income. I think it's a valuable source of information about the investment grade universe too, and I think that helps in what we're doing on our team. I will start non-core fixed income on page 32. So second quarter, there was a bit of a shift in focus in the fixed income markets. So the first quarter, the markets were reacting to higher interest rates, high inflation, higher commodity prices. Second quarter, there was a bit of a more focus on prospects of slowing economic growth, possibly a recession. So the first quarter was, a lot of focus on interest rate risk. Second quarter was a lot of focus on credit risk. And what we saw in the second quarter was a spike in high yield credit spreads that led to higher quality bonds outperforming lower quality bonds, which was a reversal from what we saw in the first quarter. First quarter being all about, mostly about interest rate risk. Lower quality bonds tend to be less interest rate sensitive. So they did better than higher quality bonds actually in the first quarter. In the first quarter, we saw some spread widening, but it wasn't dramatic. But we've seen saw a significant spread widening in the second quarter, and more spread volatility here in the third quarter with the rebound in the markets that spreads have tightened quite a bit since the end of June. In preferred securities, preferreds outperformed high yield largely due to the fact they have higher average credit quality. And emerging market debt, the risk off sentiment continues to weigh on emerging market debt. A stronger US dollar was, as well as higher US interest rates have been a pretty strong headwind for emerging market debt in the second quarter as well as the year to date. Performance track record, you see the graphics there on page 33. Page 34. High yield bonds were down almost 10% in the second quarter, which I think gives us the worst start of a year on record for high yield. But the asset class outperformed by 10 basis points in the quarter. Our high yield manager performance was mixed, I'd say, but generally the more conservative approach by our managers was a plus. The drivers of that outperformance, even though it's slight, the exposure to preferred securities, which did better than high yield, that was a positive. And as well as that conservative approach I mentioned in the high yield, in higher managers. Emerging market debt continues to be a drag on relative performance. Emerging market debt has underperformed dramatically in the asset class over the last year. There were no changes to the roster of managers in the quarter, and there were no inflows or outflows in the asset class during the period. Any questions about non-core fixed income? Seeing none.
Doesn't look like it.
Yeah, go ahead. What's that? Oh, sorry.
It doesn't look like your questions.
Great. Domestic equities on page 35. So as I mentioned with non-core fixed income, kind of that shift in focus, that more concerns about slowing growth or recession. We saw a continuation of what we saw in the first quarter, which was what they call a repricing of risk or multiple contraction, is what the market might be willing to pay for a unit of earnings. In short, that basically says PE ratios have collapsed. That's what's happened this year. All of the sell-off year to date has come from lower PEs, from that multiple contraction, as earnings per share growth has been positive so far this year. The dynamic really of that repricing of risk meant that value stocks outperformed growth stocks by a wide margin. Large caps tend to do a little better than small caps by a much smaller amount than value beat growth. And what we're looking at now is the market fears of slowdown or recession. They're more focused right now on earnings for the second quarter and company guidance. So far, earnings expectations have held up, but the market's really trying to assess what the impact on earnings a slowdown or a recession would have, and maybe fears that a drop in earnings would be the next shoe to drop. The rebound, we saw a pretty significant rebound in July. That was driven by expectations, that maybe the Fed's not going to be so aggressive. Maybe they'll slow down, maybe even pause. But so far the cuts to forward guidance or forward earnings expectations has been pretty modest. Certainly, I think a recession would likely change that. Page 36, you see the track record. Page 37, performance. The domestic equities asset class outperformed by 5 basis points for the quarter and 12 basis points for the trailing year. The overweight we have to small caps was a very small drag on relative performance for the quarter. And for the last year, the portfolio benefited from active management in the third quarter of 21, which was a positive boost to relative performance. Page 38. Again, we are all indexed investments as of late last year. Small overweight to small caps. No changes in the manager roster in the quarter and no in or outflows in the asset class in the quarter. Any questions on domestic equities?
Don't see any.
Page 39. International equities, generally the same story as we saw in the US with high PE growth stocks faring the worst, value outperforming growth, large caps outperforming small caps. International stocks outperformed US stocks. Asia Pacific was strong, particularly China. That outperformed the MSCI China index actually had a positive return in second quarter, if you believe that. But that also was a driver that led emerging market stocks to outperform developed market stocks. Year-to-date, international stocks have underperformed US, largely due to currency effects. Stronger US dollar year-to-date has been a significant headwind for international stocks. The charts for the track record and performance. Page 41, the asset class outperformed by 21 basis points in the second quarter. We had more active managers outperforming than those that didn't, but there really was no discernible theme to which managers outperformed and which ones didn't. We had a blend of large cap and small cap growth and value managers that outperformed in the quarter. But the asset class is underperformed by about 1% over the last year. We saw more broad-based underperformance by our active managers, with one large cap growth manager having a much larger magnitude of underperformance over that time period. Page 42. About an equal split between active and passive in the asset class, small overweight to small caps, very small overweight to emerging markets. And as in domestic equities, there are no changes to the roster of managers and just a very minor rebalancing activity that occurred in May. That's it for international equities. I'd be glad to answer any questions about any of the asset classes.
Anything? Nope.
Thank you for coming off your vacation to do this.
Yeah, thanks for taking time away from wherever you are.
Yeah, I don't know what Thomas's deal was. You probably can't see because of the blurred background, but I'm patting myself in the back, so. But, no, I'm glad to talk to you and give you an update on what's going on in our world. So.
All right. Well, thank you.
Thank you.
Stip, well, I know what Kirsten's deal is, and she cannot pat herself on the back, so.
She's out there with
I
this
will.
huge thing.
What'd she do?
She broke her arm, her elbow.
Oh.
Basketball.
Yes.
Bull riding.
Bull riding is what we've been, yeah, that's what
Bull
Carver
riding.
was telling everybody, yeah.
Well, actually, it was a retaining wall. Need to be clear, but
Riding a retaining wall?
they were tough days.
So, yeah, so Kirsten is running the STIP in the morning from home, but I will fill in for her. Today. Yield on the portfolio was up to 1.37% at the end of the quarter. It continues to rise. I think in the neighborhood of 185 today. So 0.11 yesterday. Yeah, that was a little bit of a, well, how State Street pulls back in the IBDDA. But yeah, so, but still directionally.
What's that? Tuesdays are bad because we get, Tuesdays are bad. Well, they're good, but they're bad.
But certainly
I
headed
thought we
in
were
that.
over, I thought we were over Tuesday.
Well, that day we were, but we're headed in that direction, so yay. Local governments, their percentage was down to a little less than 24% compared to about 30% a year ago. They're not actually pulling money, it's just the denominator has increased enough to dilute their ownership percentage. That denominator is a little north of 7.5 billion right now, over 1.3 billion on the year. The reserve is up to a little north of 57 million. We've increased the daily reserving a couple of times during the year in April and May.
That's a huge increase from one year to the next.
Yes.
Why?
So a couple of things. There's still stimulus money floating around, but you probably heard about the budget surplus. And I don't want to comment too deeply on that, but yeah, the state and local governments have a lot of money.
So the budget surplus is in STIP.
The budget surplus is mainly in STIP. It's mainly in the treasurer's fund.
Okay.
And the treasurer's fund is the vast majority of STIP. And again, as well as local governments putting their surpluses in STIP.
Okay,
And that's any questions on STIP?
On the STIP reserve, it says at $57 million, but someplace else I saw it was $75 million.
That would have been a misprint, Mark. Sorry about that.
I don't know if it is, but I find it.
But the 57 is the right figure.
Okay,
Yeah. Any other questions?
no. And are you doing state fund?
I'm gonna do state fund, yes. State fund, the portfolio return was negative almost 6%. It was led by very strong performance in real estate. The portfolio itself outperformed the benchmark by about 48 basis points. The investment grade portfolio or the internally managed portfolio returned about 7.36% over the year, outperforming its index by 54 basis points. So again, short duration, but the difference why it didn't outperform as much as the other portfolios is just it's much heavier in corporate securities. And as those spreads widened, that had a negative impact. We're much heavier in corporate securities there for yield purposes and willing to accept those volatility changes. The duration remained short, the benchmark at quarter end, with the continuing overweight to spread product and underweight to treasuries. And again, hoping to find opportunities to add mortgage-backed securities over time. The state fund's real estate allocation was in excess of the policy statement by a very small amount at quarter end. It is now below the top end of the benchmark. That was driven by a couple of factors. One was that there was just the dramatic outperformance of real estate coupled with the underperformance, the denominator effect of the core portfolio. So without us making transactions, that caused it to go over. And so we did sell, and we also have sell orders in with the UBS manager that has been ongoing for several years now. So we never expected that manager to take so long to return the capital. Had they done a more diligent job, we probably would have gone over at quarter end. Yes. And so, yeah, so we expect that percentage to continue to decline, but as of now, we're back in compliance.
Okay.
Trust fund, the portfolio returned negative 2.79, underperforming its benchmark by 47 basis points. So that underperformance was entirely driven by real estate, but it's easy to understand that in the context that that portfolio held a lot of CMBS real estate, which underperformed, but still had a yield very attractive compared to core fixed income. Additionally, we went in quicker and heavier into real estate than our original projections. Then as we did that by going into the large core open-end funds. Then as Ethan had time to find good core plus opportunities, we've added to those funds. Those funds have that J curve effect. And so the large majority of this underperformance was driven by that J curve effect, and we expect that we're going to get that back over time. So yeah, kind of a large number, but nothing in my opinion to panic about. High yield returned 12.16%, outperforming its index by north of 60 basis points. And the internal portfolio outperformed its benchmark by 135 basis points short duration. Its duration was in fact a little shorter than the core portfolio. So that's why it had a little better performance, Total trust fund at the end of the quarter was a little north of 2.8 billion. Duration was below the benchmark again, underweight. Overweight to risk assets in general, but not by a significant amount. Trust fund purchased almost 200 million in real estate during the year, and we were about 27% real estate at the end of the year. Any questions on the trust fund?
Okay, John, anything else? Yes.
No question. It's just so minor, but I was just looking at the appendix stuff on page 55. I was surprised to see that the UK was our single largest holding other than the US, and it's so small compared to the US. But given Brexit, and I know you guys just did a trip there, I was really surprised that is that just because they're a financial center and that's why?
I'd have to look at this
Yeah.
specifics in terms of managers. I would say just high level broad comment. There have been a lot of managers that have been attracted to the UK because they got hit so hard with Brexit. And so from some valuation perspective, it was looking relatively attractive. And I think also maybe partly from a currency perspective in terms of the pound being viewed as, not as strong as the dollar, but maybe stronger than the euro in some other areas where you might be. So I know it's been just broadly within quarterly calls, mentioned as a somewhat attractive
Interesting, because
place to be, but I couldn't give you specifics off the
And
top of my head.
it's not germane to our whole.
Maybe Jason can if he
Oh, it
remembers
doesn't.
anything.
I was just surprised given their financial troubles, but maybe that makes sense. Yeah.
Well, it's sort of as we've talked about a lot of times, the cleanest dirty shirt sometimes in the space, and where do you want to be? And
Thanks.
Anything else? Anything else for today?
Nothing today. Yeah, nothing today.
9:30? Well, 5-ish?
So apparently it's windy. I don't know, there's no windows in here. So the food will be set up in the conference room and then people can grab it and wander around. Staff will be available, so.
What's going to be inside?
Yep. Unless you want to go outside, you're in charge.
If we,
You got a half hour to go get cozy and
we leave, till we come back, can we get back in?
we will make sure you can get back. Your card should work. You all still
But
have.
what about, is the work downstairs door get locked?
Okay, if your key card will let you in the building,
Oh, okay.
but we'll probably open for you. 'cause-
Well, I'm just asking.
You're the chairman.
I just.
All right.
You don't have to keep
Tell
it.
the buffet
Yeah,
like four.
Ben.
Then we'll let